Okay, welcome to the December 2024 UCLA Anderson Forecast Conference. We have a lot to talk about today. We have an election that has been concluded. We have new economic policies, and we're going to dig into that. Before we do that, let me tell you what we've got coming up. The first part of our program will be presentations on the forecast. We're going to lead off with the US forecast and then the California forecast, and then a look at the financial landscape. So let me start with introductions for those of you who do not know me. I'm Jerry Nicholsberg. I am the faculty director of the UCLA Anderson Forecast. With me today from the forecast team is Clement Bohr, and he leads our US forecast. So he'll be the first speaker. And then I'll follow with California. And then David Schulman, who all of you know, is back with us and is going to talk about the financial landscape. We also have with us as part of our team, William Yu, who's been with the forecast for about 12 years. William works on China, which is very challenging today, as well as Los Angeles. Thomas Ash, who is a regional economist, works on issues of finance and on the environment. And Ji-Yoon Lee, who is the Mercury Insurance climate change economist at the forecast. So they're all with us here in the front row. They've been presenting at other conferences and will present at future conferences. So absolutely feel free to engage them. I also want to thank our support team of Seth, George, and Virginia. They're the ones that really make this happen. And we're very grateful for everything that they do that makes us look better. And in addition to those, we are, as you know, a public institution, and we could not put on these programs without the support of our sponsors. And so we're most grateful for them, and I want to thank them. And so beginning, our principal sponsor is sponsors are RSM and Yamava Resort and Casino at San Manuel. At the platinum level, the law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Mercury Insurance, and University Credit Union. At the gold level, Avenue Insights and Analytics, California Steel Industries, Hub Insurance, Leap Development, PNC Bank, Robert Half, and United Airlines. At the silver level, Bank of California, Chevron, Comerica Wealth Management, JLL, Marsh McClellan Agency, MBK Real Estate Companies, U.S. Bank Private Wealth Management, and Wilmington Trust. At the bronze level, Hanmi Bank and HDR. And at the Bruin level, Gerber Kawasaki Wealth and Investment Management, and our academic sponsor, UCLA Extension. After we do the forecast part, then we have a special treat for you that today the Robertson Lecture Series is going to be presented. And so that's going to be the middle part of our program. And we'll tell you a lot more about that later. And then following the Robertson Lecture Series address, we have a panel that is put on by the Fink Institute for Finance here at UCLA Anderson. And so they are jointly sponsoring this event with us. So those are all of our announcements. And let's start with what you're all waiting for. What's going to happen with this new administration in the US economy? Let me turn it over to Clement.
Thank you, Jerry, and good morning, everyone. So as you just alluded to, and what you probably could have guessed, today's main topic will be primarily about the economic implications of the incoming administration's policies. And there's a lot of uncertainty regarding these policies and what shape they're going to take, which is why we have this cloudy title, even though it looks a bit misplaced behind this beautiful UCLA blue sky background in this slide. But beyond that, one thing that does look more certain is that most of these policies do point towards an elevated level of inflation going forward. There's a lot of upside risk to inflation because of a lot of these policies. But before we start talking about these policies, I'm going to take a little bit of time to talk about the current state of the US economy and really just talk about how good it's still doing and how robust it's doing despite the high levels of interest rates. And in fact, the economy has been doing even better over the past couple of years than what we already thought of how well it's been doing. So every year, the National Economic Accounts do an annual revision where they take more comprehensive data from the IRS and from the Census Bureau and get more comprehensive estimates for what GDP growth and other estimates going back over the past couple of years. And so that's what I'm first of all showing you in the left plot, where I'm showing you the old before the revision quarterly GDP growth rates in light blue and the new updated quarterly GDP growth after the revisions in dark blue. And what you see is that through 2021, 2022, and 2023, GDP growth was actually higher than what we previously estimated. One fun fact there that you can take to your next cocktail party is that in the early part of 2022, if you remember back then, there was a lot of talk about a technical recession. We had 2 quarters of negative GDP growth. That's not the actual definition of a recession. It's a good rule of thumb, and the actual definition is much more complex and subjective for better and worse. But regardless, after these revisions, we actually did not have 2 consecutive quarters of negative GDP growth. As you see, after the revisions, the second quarter actually turned slightly positive. So that is now a mute fact, regardless. The more important part of this revision is what I'm actually showing you in the right plot, where you see the prior estimates of gross domestic product and gross domestic income in the dashed lines, and the solid lines show it after the revision. And as you can see in the dashed lines, there's a very large gap between the estimates of gross domestic product and gross domestic income. By an accounting definition, these two should be equal. And so even though gross domestic product was growing strongly before and looking good, there was a lot of concern among economists because gross domestic income was really much falling behind. And so the question was, well, what was the better depiction of what the actual economy was doing? Was gross domestic product was showing a very positive signal, but perhaps gross domestic income was the more real scenario where we should be more cautious about how well the economy was doing. But what you see after the revisions, not usually after the revisions, the actual estimates converge towards somewhere in between, about an average of the two. But instead, here we actually got an upward revision in GDP growth, as well as a substantial upward revision in gross domestic income that showed there now that the statistical discrepancy between them is much smaller, and they're actually very high, both of them. So a lot of those concerns related to that gap between them has also now gone away. And this is not the only positive economic news. This is not the only positive news we had this past fall over the last couple months here. So here I'm showing you a couple other events that happened, which help explain why long-term rates have risen despite the Fed cutting rates. And what I want to focus on first is the middle one, where I've shaded in gray the time in early October where we got the BLS payroll employment report. And that was a very strong employment report that showed that we had a monthly gain in employment in September of more than 250,000 people, which is well above the estimates and expectations, which were around 150,000. And as well, up until then, unemployment had been rising, but that report really, cut that off and stabilized the unemployment rate around 4.2%. So in the dark blue line, what I'm showing you is the 5-year Treasury yield on U.S. government bonds. And so you see during that period, there was a large upward increase on those days to it. Another part that I've also shaded is the election results after November 6th, where Trump was elected. And you see there's a small spike there, but it's not quite as big. And that's why I've also plotted you here the yellow line, which is the Treasury inflation protected securities yield on the 5-year government bond. So that is this same underlying asset of debt, U.S. government debt, that you get from that. But those treasuries have the coupons and face values indexed to the inflation rates, which means that the yield you get on those is only a real yield. So we have the nominal yield in blue on U.S. government debt and the real yield in yellow on U.S. government debt. And so to get the inflation expectations, all you have to do is take the difference between them, which is what you see in the right graph here. And what you see relative to the first plot, on the right plot for the November election, the minute it was clear that Trump got elected, there was a big bump up in this break-even inflation rate. So there was this rise in inflation expectations on the news that President Trump was elected. To give you a little bit more insight into this rise in inflation expectations, the Bank of America does a survey every month of global fund managers. And this November survey was very special in that they had the responses come in throughout the presidential election, both before and after. And so we got some results both before he was elected, as well as some sort of fund managers answering their responses after. And that's what I'm showing you first in the left-hand plot. In the last bar, which is not filled in, that's only the responses that came in after the president was elected. And so what you see is that what they were asked is what they thought the probability of a soft landing was, a no landing was, or a hard landing going forward. And what you see is that the probability of a soft landing became smaller, while the probability of no landing, i.e. higher levels of inflation going forward, became larger, while the probability of a hard landing was still very small at 8%. The right plot gives you the same amount of information, but in a different way. All I want you to focus on there is the very end of the dark blue line, where you see the red dot is what the answers were after President Trump was elected versus before. And this survey question asked the fund managers, do you expect the global CPI to be higher over the next 12 months? So the price level to go up. And what you see is that after Trump was elected, that became positive. So on net, global fund managers suddenly expected global CPI to be rising over the next year instead. So with this discussion of interest rates, where do we see it headed? This morning, we just got the most recent release of the Consumer Price Index. And what we saw was that it was very much in line with expectations, which came in about year over year, about 2.7%. So inflation is looking stubborn. There was a little bit of positive news in there, which is that the most stubborn part of inflation so far has been the cost of shelter. And that did show a slight downtick, so showing that it's finally beginning to fall a bit. And so this report didn't really change the market expectations. It's not a certainty, but it's looking like the Fed's most likely going to cut another 25 basis points next week. And so that's what we have in the forecast. However, after that, we expect the Fed to be much more careful cutting because of all the policy uncertainty and the upside to inflation going forward after that. So we have them holding the federal funds rate through most of next year, as we do see some rise in a temporary boost in inflation from tariffs, along with then a cut towards the end of the year to the 4 to 4.25%, which will then hold for there going forward, at least through 2026. And then for long-term treasury rates, such as the 10-year treasury rate, which is what I've plotted here in the thick dashed line, the thick solid line, we have that continue to rising as it has been so far. And it's going to peak at around 4.8% towards the second half of 2025, in line with some upward tick in inflation until then. But then after that, it's going to gradually fall as inflation starts moderating a bit as well. Okay, so turning to the main point of this forecast, which is the incoming policies. And these policies are fairly well depicted in this comic, which is what Trump has promised of tax cuts, tariffs, and deporting immigrants. And it's also what he very much doubled down on in his recent Meet the Press interview this past Sunday. And before we get into the details, we here at the forecast, we have to emphasize the amount of uncertainty there is in this forecast of these policies, because as I'll outline here, there's actually 3 levels of uncertainty you can talk about related to them. First, we don't know the actual details that these policies are going to take out or that Trump is going to implement, because Trump changes his mind and they shift day by day sometimes. So we'll see what they actually decide to try and push through. But beyond that, there's also the level of feasibility. They're going to be faced with political constraints. They're going to be faced with legal constraints and also resource constraints in terms of implementing some of these policies, depending on which ones that they want to try and implement. So there's not just a question of what policies they implement, but also how successful they're going to be in implementing those policies. And then lastly, a lot of these policies are fairly substantial in size. And for tariffs, we do have a good understanding of their economic impact. But for some of the other ones, like mass deportations, we don't have a lot of good historical scenarios and good empirical analyses of the implications of such large-scale mass deportations. And so we can conjecture about the economic impact of those, but there's a lot of uncertainty about what type of effects that's going to have on the economy. And so when we talk about that, we're going to have to emphasize the amount of uncertainty there is related to those impacts of the mass deportations. So to deal with these, for the policy specifics, we're going to minimize the level of speculation in this forecast and go with the policies that he's most recently proposed, conditional on those policies actually being feasible. So some of these policies we have implemented in this forecast, we're going to assume moderation, but it's really relative to moderation. They're still very substantial policies, but they're moderate relative to some of the more extreme policies he has outlined. And then again, we have to emphasize the level of uncertainty in this forecast. So these are the forecast economic policies that we have in the forecast. We have that he's going to lay, as he most recently announced, 25% tariffs on Mexico and Canada, and an additional 10% tariffs on China, which will put the average tariff rate on China to about 35%. We have that they're going to extend the Tax Cuts and Jobs Act of 2017 and through beginning in 2026. Going forward, Trump has proposed a plethora of other tax cuts. We're not going to put them into the forecast yet because there's so much uncertainty about which ones that are actually going to be implemented, and also which ones he's going to be able to get his very narrow majority to implement. Already this tax cuts, just extending this Tax Cuts and Jobs Act, it's hard to know where they're going to find the funding to balance the budget on that. And he's also nominated Treasury Secretary Scott Bessent, whose stated goal is to reduce the fiscal deficit to 3%. And so it's hard to square how they're going to reduce the fiscal deficit to 3%, as well as implementing a lot of these additional tax cuts. And lastly, for the deportations, his stated goal is to deport all illegal immigrants of around 11 million. We have him that he's going to end up deporting up to 1 million a year. Okay, so as I mentioned, these policies that we're implementing in the forecast are substantial, but they're moderate relative to some of his more extreme proposals, such as the 60% tariffs on China, along with 20% across the board on all other countries. He's also proposed an elimination of the federal income tax completely. And as I just mentioned, he's also proposed deporting, all 11 million undocumented immigrants. So these policies that we have implemented are feasible. For the tariffs, all you have to do is look at the executive authorities he used in his first administration to get some of these through. So for instance, he used Section 232, which is the one in the bottom left, to put tariffs on steel and aluminum, which is a trade policy he can use to restrict imports that threaten national defense and economic policy. On the bottom right, we also see it very likely that he may implement the International Emergency Economic Powers Act. This is something that he did not use in his first term, but is when he's talked extensively about using this term to enact these policies, say tariffs on all goods from Mexico and from Canada. For the deportations, up to 1 million a year sounds very aggressive, but it is feasible. All you have to go back is to look at the first Obama term, and what you see there is that he actually deported on average 400,000 people a year in that first term of his. We have also had mass deportations in the past where we deported a large amount of undocumented immigrants in the 1950s and 1930s. However, since then, immigrants have a lot more legal protections than they did back then, and so it's going to be tougher, but they've already talked about how they can get around some of these due process procedures, such as using expedited removals. They can use those for the approximately 1 million undocumented immigrants that have either felonies or misdemeanors. They can also deport immigrants that have entered in the last 2 years, and they've also talked about using that 2-year cutoff for all undocumented immigrants, as long as they can't show proof that they've been here for more than 2 years. And then the president has different types of authority he can use to actually get some of these things through. For instance, he can use the National Emergency Act of 1976. He used that in his first term as well, when he wanted to, when he reallocated resources from the military to fund his border wall and construction. He's talked about using the Alien Enemies Act of 1798. I wouldn't count on him necessarily using that, as that would require him to, in some sense, declare war on Mexico. But one thing that's much easier for him to do is also to tighten protocols at ICE and the Department of Homeland Security. Next, to look at the effects of these policies, we're going to start with the tariffs. And all you need to do to understand the effects of the tariffs is go back to the effect that they had in his first term. So here I'm showing you the 2018 tariffs that he put in, and you can see in the left plot, they were implemented in 6 waves throughout the year of 2018. Where you see at the very beginning in February, he put tariffs on solar panels and washing machines. And then towards the end of the year, he put in tariffs on China on a much larger plethora of goods. And then in the right-hand plot, I'm showing you the effect that had in terms of prices. So these are two different price indices for the imported goods that the US imports, and it's split into two groups. One is the goods that we imported that did not feature any tariffs. And the other one is the goods that we imported, which is the solid line, which are the goods that did have tariffs implemented on them. And what you see is that before 2018, they both featured a downward trend. That's pretty typical for goods as innovation makes these cheaper to produce over time. However, in the dashed line for the goods that did not feature tariffs, you see that trend continuing down and becoming cheaper, while the tariffs that were imposed on the goods in the solid line, those the price index reversed there, and the goods prices started becoming a lot more expensive there. And the analyses of these 2018 tariffs, which there's a lot of good studies out there, show is that the U.S. economy bore all the costs of these tariffs. All of it was passed on from the Chinese exporters. They did not change their prices, and all of the cost was mainly on the U.S. consumer. So what do we import from Mexico and Canada? What prices are should we expect to rise from these tariffs? What I'm showing you on the left are the different goods we import from Mexico, and on the right, the ones from Canada. And what you see across both of them is that a lot of the goods we import are transportation equipment like cars and vehicles, but also a lot more machinery and electrical equipment in general. And so you should expect a lot of those prices of those core goods to go up. Something else that's very notable is that, particularly for Canada, we import a lot of energy from Canada, and the last thing Trump would want to see happen is a large rise in energy prices. And they were acutely aware of this type of issue in his first administration, where they had. So he's also nominated Kevin Hassett to be chair of his economic council in his next term. And from his first term, they had this concept known as the Hassett algorithm, where they tried very much to put tariffs on the goods that would not come up strongly in the headline inflation rates. So I would not be surprised if there was a carve out for crude petroleum or for energy prices on these tariffs. But we don't have that in the forecast. Our forecast is for all goods from Canada, as he most recently stated. For the mass deportations, we expect these to raise goods in certain industries, and in particular in the agricultural industry, which would lead to higher food prices in the US economy. This would not necessarily be the case if these undocumented immigrants were spread across all the industries in the US fairly evenly, but that's not the case. They are very concentrated in some industries, such as construction and agriculture. And what I'm showing you here is that within the agricultural sector, the majority of the workers are actually immigrants, with majority of those immigrants being undocumented immigrants. So in the blue line bar is the foreign-born undocumented immigrants. But if you also account the foreign-born documented as well as the foreign-born U.S. citizens, you see that the immigrants make up, close to 70% of the agricultural labor force there. So when we lose a lot of these workers, what that's going to implement is either the cost of wages are going to have to rise dramatically to make up for that, to entice other workers to get in there, because this is the type of job that a lot of domestic-born citizens aren't interested in doing. And if we can't get enough workers to compensate for the ones we lose, then we're going to have some product shortages, which will also, whether we have product shortages or much higher production costs from higher labor for wages, it's going to end up being higher food prices. Okay, so turning to our inflation forecast, now that you have the context for it, what we expect in 2025 is a temporary boost to inflation from the tariffs, where inflation is going to average around 3%. Core inflation is going to be slightly higher than the headline inflation. That's because that's what the case is right now, with services inflation still running hot after the pandemic. But it's also because of what I showed you from the imports from Mexico and Canada, where a lot of the tariffs are going to hit machinery, cars, and transportation equipment. Turning to 2026, we then see inflation to come down slightly, but not very much, where it's going to average 2.8%. And most of that's going to come from the deportation. So the lack of workers in the labor force is going to boost up food prices. And that's why we have headline inflation here being higher than the core inflation. And lastly, I've also plotted here in the very dotted thin line, the employment cost index, which is a measure of wage inflation. And what you see there is that we do not expect a further decline in the wage inflation. In fact, it's going to start rebounding up and recover up until 4.1% on average in 2026. as some of these shortages for workers in these industries start to take hold. For the outlook on unemployment in 2025, the tariffs are going to temporarily increase that slightly because of these higher production costs and the higher final goods costs, which is going to reduce the demand for labor in the US. But then turning to 2026, as I already mentioned, the effects of these mass deportations is very unclear. So from one perspective, and the reason why I have it declining slightly is that a large reduction in the labor force is going to tighten the labor supply and tighten the market. The issue is that the type of workers that we're deporting is not the same type of workers that we have in the US economy. And so what we actually find from previous studies is that some of those workers, when they leave, it also leads to higher unemployment among domestic workers. So that's because you could see if we're in the construction, for instance, if we have a lot of these workers deported that are all the roofers, well, then we don't need as many construction place managers. We don't need as many accountants to manage all these work sites because there aren't going to be as many work sites. And so this could actually also end up boosting unemployment very a lot. So there's a lot of upside risk to this unemployment rate forecast. For GDP growth, we have a fairly strong economy going in this quarter still, so we expect GDP growth to be strong, coming in at 2%. It's going to take a slight bump in 2025 because of the tariffs and the onset of these deportations to 1.5% on average. And then it's going to recover as the economy adjusts in 2026 to 2.4%. So to conclude, the US economy is still performing very strongly. But if these substantial tariffs and deportations actually end up taking place, expect higher levels of inflation and interest rates going forward. Expect GDP growth to take a temporary hit, and expect the unexpected for unemployment. Okay, thank you.
Thank you, Clement. And now we'll turn to California. So, George, can you bring up my slides? Coming up. We're almost ready to turn to California. But let me start off while the slides are coming up. The theme is going to be the same. There are two important assumptions that you heard with the US forecast. One is trade wars and tariffs, and the other is deportation of undocumented immigrants. Both of those affect California as they affect the US, but a little bit differentially with respect to California. In addition, the unemployment rate in California is substantially above the US, about 1.2 percentage points above the US. And so we want to talk about that and why that's the case and what all of this is going to mean for the California forecast. And so here you see just two images, a trade war, and then that is a picture from the 1950s from the Eisenhower mass deportations. And so where we're going to talk about GDP and what's happening in California, what has been happening in California in this political campaign, particularly since Vice President Harris is from California. You heard a lot of negative things about California. And what we want to do is we want to talk about the data and kind of what does the data tell us about California? And then we're going to talk about employment sectors, strengths and weaknesses, and then the California outlook. But before we jump into GDP, is it after? Yeah. No, let's start with jumping into GDP. I got the slides turned around in my mind. This is the first half of 2024. That's the latest data we have. Now, in the past, I've shown you data prior to 2024, where California, on a per capita basis, was the fastest growing large state in the US. And we're only looking at large states because states that are small really don't move the needle on GDP. And for example, if Delaware grew at an amazing 10%, you'd never see it in the US GDP numbers because they're so small relative to the total. So we're only focusing on the large states. This is not per capita, but this is the first 2 quarters of 2024, and California was the fastest growing state. Most of that was in the first quarter. We haven't received the revisions to the second quarter. I've heard expectations that the measure of GDP growth in California in the second quarter will go up, but at any rate, right now it's at 2.8%, which is about the same rate of growth as the US in the second quarter. And so there's been a slowdown in the rate of growth of California. Still doing well, is doing as well as the US, but not outpacing the US. So before we dig into employment and the sectors, I want to go back to the assumptions. And we've been spending a lot of time on these assumptions today because they're really important. There's a lot of uncertainty here since we're making our assumptions based on a political campaign and the statements thereafter and the political appointees, but we're really speculating as to which of these policies are going to be implemented. So with respect to tariffs, will they only be on China or China and Mexico? Now, Mexico is the #2 exporter to California, but what's really important, I think, for us is the implications of tariffs on China and how that affects logistics. And we have a high degree of certainty that we're going to have increased tariffs on China. For the labor force, this really might go two ways. We're going to have a reduction in the labor force due to deportations, and that's going to hit a whole set of sectors in California. But the tech industry is, at least from observation, much better connected with the incoming administration, and that should mean an increase in H-1B visas, because if you're going to have a reduction in the labor force and spur economic growth with new technologies, you need the people to develop those new technologies. And so in California, it might go kind of both ways, that we get more immigrants who are highly educated, spurring the tech industry, fewer people in the labor force who are lower educated, and that would be the deportations. For regulation, kind of the overall thing is we don't really have much in the way, if anything, in the way of regulation changes in our forecast. Not that they won't matter, but it's very hard to tell. I mean, we're going to have probably financial and tech regulations eased, so less oversight or less enforcement, and maybe changes in those regulations. We're not sure what those are going to be, but we do have a panel today that hopefully will bring some light to that. And environmental and energy, in California, it's hard to imagine that companies are going to invest in, let's say, coal-fired plants or anything that goes against California's kind of long trend in environmental and energy policy, because these changes in regulations may be short-term. And if it's, if that investment is contrary to California policy, look for a lot of litigation. And so while it may matter for other parts of the country, we don't think that's going to matter for California. So let's turn to employment. And I showed you this chart 3 months ago, and I'm bringing it back up because during the political campaign, there were a couple of, maybe more than a couple of papers that were saying that California's growth in employment was all due to government. And the problem with that is you see these two lines here. They're two very different ways to measure employment or to measure labor markets. And those papers conflated the two, which of course you don't do. If you stay with one way of measuring or the other way of measuring, you just don't get those results. So it's worth going through what these two are. The blue line is a household survey. So it measures employment and is taken by the Bureau of Labor Statistics, and it measures employment by where people live. And so what's in there? Well, remote workers who are living in Boise but working in San Francisco are in the Idaho labor force. And their employment or unemployment is registered in Idaho, even though their job is in San Francisco. The red line is the establishment survey. It's where people work. And so that person who's living in Boise is in the California labor force on the red line because they're a payroll employee in California. So that's one difference. Another is farm workers. Farm workers are not in the red line. And we've had 2 bad winters, and we've had a reduction in the number of farm workers. Also gig workers. And so gig workers, so delivery people who were delivering all of these goods to our houses during the pandemic and shortly thereafter, they're not in the red line, they're not payroll employees, but we've seen a real reduction in those. And family workers in family businesses. So think about teenagers who were working in a family restaurant. Now they're unemployed and they drop out of the labor force, and they're in the blue line and not in the red line. So you notice they're coming together, but payroll employment in California is at record levels, even though the blue line, household employment, which incidentally is a very small sample and is considered less reliable measure of labor markets than the red line, the red line payroll employment is at record levels. I'm sure when you were on the 405 getting to campus today, you were wondering about where all the people who moved to Texas went because they seem to still be on our freeways. And that's because of sort of the nature of the churn that's going on in California in terms of household size shrinking, but employment actually increasing. Okay, so let's look at sectoral employment. And what I want to do here is illustrate where we are anticipating an impact. And so this is the first 10 months of the year, and those in blue are the increases in employment. And if you look kind of across the first 6, you get things like healthcare and retail and education. And so these are sectors that we don't think have legs to them. And you look on the right-hand side, and you've got farm, you have tech, you have a sector called information, which is a combination of tech and Hollywood. And that's been shrinking primarily because of Hollywood. So we want to talk about that. But let me annotate these as to, where we're expecting impacts. And so, let's see, is this on? So if we look across here, is that on? Yeah. So if we look across here, we have farm employment. I talked about that. And then non-durable goods. And in non-durable goods is food processing. So that's going to be affected by immigration. I'm annotating this with an eye for where deportations are going to affect sectors in California. Construction, about 1/3 of our construction labor force is undocumented. And then we have leisure and hospitality and healthcare. And then if we look at tariffs, where are tariffs going to impact the California economy in terms of employment? We have logistics, and then we have retail trade. Okay, so these are the sectors that are going to impact California. So what's going to make California grow is going to be durable goods. So that's manufacturing, durable goods manufacturing, information, and tech. Those are going to be the drivers, if anything. So let's dig into this. This is real durable goods manufacturing output. It was up over 20% at the beginning of this year. It's dropped a bit. That's primarily in computers and electronics. But there are new factories through California that are going to be opening up in 2025 and 2026 that are producing these durable goods. And so we're expecting growth there. And again, when we have labor shortages and increasing wages, there's now an incentive for firms to substitute for labor technology, which is labor-saving capital, and that's disproportionately going to increase the demand in California. So we're optimistic about durable goods manufacturing growing in California. And here's where some of that regulation or changes in regulation might actually have a positive impact. In terms of technology, this is, so there's no tech sector per se. So we're going to look at it in 2 different ways. This is professional, scientific, and technical services, a sector that's heavy in technology. And what you see here is the dip with the lockdown, and then it reaches a peak, and then you've got the layoffs that we heard so much about in big tech, but it just kind of flattens out, right? Now, part of California's higher unemployment rate is due to those layoffs, but that's not getting worse. And in fact, if tech is growing, expect that to be absorbed. And certainly with AI and other investments that we see happening in California, we're expecting that to grow. Another way to look at it is what I call computer tech. So this takes some subsectors from larger sectors, subsectors that are focused on the development of computers, the design and the software that is associated with it, and it looks pretty much the same. So a decline there. You saw the decline in the sectoral analysis of 2024. That decline has stopped. We're expecting growth here. And what about information? Information was declining primarily because of Hollywood, that the entertainment sector was shrinking. There was too much streaming, and this is employment in film, TV, and streaming in California. And you see that big decline, that shaded gray area are the two strikes. And you come out of the strikes, and what we see is this is just kind of flattened out. So this is no longer a drag on the California economy. It does add to the US unemployment rate about 0.4%. And so that's one of the reasons why the California's unemployment rate is higher. And about half of the people who are unemployed in this sector were independent contractors. Let's turn to logistics. And I want to look in logistics at seaports and airports. So the top graph here is seaports. And so there are two different scales. The red line is imports through Los Angeles and Long Beach ports combined together. Those are massive ports. They're the largest in the Western Hemisphere. And so they they're measured on the left-hand scale. The other two are the two major West Coast ports. So this San Francisco Bay Area, principally Oakland, and the Puget Sound. And I've added in the Puget Sound so we can see what's happening in the West Coast. So starting with the top line, you see this growth as we come out of the period of time when freighters were being diverted to the East Coast because of the threatened strikes. Now that's kind of normalizing. This data goes through October. We're not seeing the surge of imports yet in November, December, and early January to get around the tariffs. And so expect that to grow. And we're back to above pre-pandemic levels. Okay. But after the tariffs are imposed, some of that stuff that was brought forward will not be coming in. So expect that to decline a little bit. But as the US economy grows, and you saw in our US forecast, the economy is forecast to grow, we'll get increased demand for imports in spite of the tariffs. And so this will mean we'll have an increase in goods flowing through the seaports, okay? But a small increase. So kind of the gradient is going to be really small. The other two here, the other two ports, the smaller ports, San Francisco Bay and Puget Sound, they're not back to pre-pandemic levels, right? So this is really suggesting there's not a lot of inertia here. And then on the bottom, you have international air cargo on the left-hand side, and that's LAX. And so the bottom line in orange is going to be imports. And that's kind of flat because, you know, as bad as people think the US economy might be, is so much better than everywhere else. And so we're not getting that demand for our exports. The top line is imports, and it is you know, pretty much back to pre-pandemic levels, but the trend is kind of flat. And so there are two things working on this. One is as we get more flights from China, there'll be more capacity, more belly cargo space. That should increase it. As we produce more chips at home, that should decrease it because chips and semiconductors usually go by air. What's a little worrisome for logistics is what's on the right-hand side. That's Northern California on the top and Southern California on the bottom. That's goods flows through our airports, including LAX and SFO, but all the regional airports in California. And if you move your eyes over to the right-hand side, you see that it's flat to negative. Right? So all of this says that logistics, which has been a prime mover of the growth in California over the last 5 years, is not going to be going forward. We're expecting a little growth, but not much. Now turning to housing, on the left-hand side is home sales. And you see it's still at depression levels. We boomers are not selling our homes. We have 3% mortgages and we're not selling because we don't want to go into 6.5% to 7% mortgages. And so there's very little inventory. And on the right-hand side is the Case-Shiller home price index for Los Angeles, San Diego, and San Francisco, all normalized to 2016. And so the top one is San Diego. So these are normalized. So San Diego prices aren't higher than San Francisco, but San Diego prices are at record high. Los Angeles prices are at record high. The bottom one is San Francisco, and those prices came down and they've now been going up, but they're not above the kind of previous pandemic time peak. But with higher prices and low inventory, you should expect a building boom in California. But when we look at what has been happening on the right-hand side here, which is permits, what you see is that permits, kind of move your eyes all the way over to the right-hand side, permits are really not increasing by much. They dip because of weather events, but then you don't see a big boom in permits in California. You might expect that this is going to change and we're going to see a real solid increase in construction. But on the left-hand side, you see construction payroll jobs in California. And if we start all the way over on the right on that graph and draw a horizontal line, our construction payroll is as large as it was in the speculative building boom in 2006. So we're running out of construction workers. And if 30% of those construction workers happen to be undocumented, then we have a real problem of increasing home construction in California. And so we have that also as a sector that is not growing very fast. Other sectors of concern, and I show two of them here. On the left-hand side is K-12 enrollment. So enrollment in public schools in California, and you see it's been declining. And we know that because of the closure of all of these schools. If we have families deported over the next few years, we're going to have less enrollment in these schools. So education, which was one of those sectors that was on the left-hand side of growth and employment in California in the first 10 months of this year, is not going to be a growth sector. It's going to be a drag on the economy. On the right-hand side is about delivery drivers. And we had a lot of folks delivering things to our homes during the pandemic and shortly thereafter. Many of these are gig workers, but some are payroll employees. For example, with Pizza Hut, they eliminated all of that, and that was 2,000 jobs. This is an area that we really don't expect to grow, and we're seeing a contraction in the number of couriers. So with all of this and these kind of conflicting sectors, I asked, how are we going to make a forecast? What assumptions should we make? And I looked around for someone who was really smart, but had no political views. And you might think that that's impossible, but I did find someone and I asked the question, what assumptions should we make? And this is the answer that I got. So the point here is keep in mind, we're making specific assumptions. But as the next year unfolds, those assumptions might not be correct. And as you see us moving away from those assumptions, think about how the forecast changes. So our having made the assumptions that I told you right at the beginning, we have manufacturing, finance, and tech recovering, and those are really going to be the growth sectors in California in 25 and 26. Agriculture and construction, there's a big question mark there. And then slower growth in 2025 than we had 3 months ago. Also slower growth in 2026, but it'll be accelerating from 2025. And the risks are the size and timing of deportations, more extensive tariffs than we have assumed, and retaliation by our trading partners that's going to affect goods flow exports through California's ports, and of course, geopolitical. So just some numbers here to finish up. We got payroll job growth. And before we had by 2026, that we were going to be back to 2029 very normal levels of job growth. Now we're going to be under that. Not by a lot, but we're going to be under that. The unemployment rate going up on average to 5.5% for the year 2025, then starting to fall. By the end of 2026, it gets slightly under 5%. And building permits, we have increasing, but increasing slowly and only getting to 138,000 new residential units in the year 2026. Not going to get to the 3.2 million that is thought to be needed in California anytime soon with these kinds of numbers. And so that brings me to the end of the California forecast. Thank you. So now let's turn to David to talk about the financial landscape. David.
Good morning, everybody. I have a few main, consistent with the forecast. We don't see Treasury yields falling much below 4%. We're not going to rely on the Fed to significantly cut rates. Inflation will remain above the target of 2%. There's all kinds of political risks that were discussed, from deficits to trade, deportation, and a potential Trump-Fed war. Stock valuations are elevated by nearly all measures. And unfortunately, the long-run outlook for stocks is not pretty. First thing here is interest rates. The era of extraordinarily low interest rates are over. The red line is the federal funds. The blue line is the 10-year Treasury. We will get a cut next week. My guess is that this will be characterized by the financial press as a hawkish cut. But what I mean about that is they will cut rates, but then they will tell the markets, don't count on many more in the future. And we will also get the review of new summary economic projections, where the Fed will outline their projections on interest rates, inflation, and real GDP growth and unemployment. And my guess is all the real activity is going to be much higher than what they did in September. Because if you recall, in September, they were saying Fed funds were going to go below 3.5%. By end of 25, they're not going to say that this time. So it'll be, in my view, it'll be a hawkish cut rather than, hey, they cut rates and they're going to keep cutting. They say we cut this time, and then the Fed will strongly hint that they're going to pause. So we'll see what happens next week. All right. The other thing going on is that the Fed continues to shrink its balance sheet. That is a quasi-tightening. If you take a look, the balance sheet through 2008 was always under $1 trillion. We had all the quantitative easing in 2009. They doubled the balance sheet. But the real big easing happened when they went from 4 trillion to 9 trillion as a result of COVID. They're taking the balance sheet down from 9 trillion, probably down, maybe they'll stop at around 6 trillion, 5.5 trillion. And that's sort of like a soft tightening where they're pulling reserves out of the financial system. And that is going to continue. And it's been going on like clockwork. The little blip up you saw there in the chart is when Silicon Valley Bank failed. All right, inflation. The inflation is bottoming. As Clemens said, the risks are to the upside. The blue line is headline. The red line is core. And today we had 0.3 on both. We annualize the 0.3, that's 3.6%, not 2%. So inflation is staying stubbornly high. My analogy for why inflation is taking so long to come down is when people go on a diet. So you have a plan to lose 25 pounds or 20 pounds. So the first 10 or 15 pounds are easy. The last 5 pounds are a bitch. And that's basically, and I think that's basically what's going on with the inflation rate. To get from 3.5 down to 2, very difficult. Going from 8 to 3, you could do, but from 3 to 3.5 to 2, very, very difficult because there's a lot of inflation built into the system. Why will inflation stay high? One, we have rising deficits, tariffs, deportation, deglobalization. Now remember, the whole purpose of globalization was to find the lowest cost, make our stuff in the lowest cost places all around the world. If we deglobalize, we're not going to go to the lowest cost production. We're going to do things for all kinds of reasons. We're going to have reshore and we're going to have domestic production. That is going to cost more than importing stuff from China, Mexico, Vietnam, or wherever. And that's a bias for higher inflation. And the other thing is we have to deal with energy transition. And energy transition is going to be expensive. And we have a new wrinkle with energy right now is all this AI, which requires huge amounts of power. Prices of electricity, if you think they're high now, they're going to go a lot higher because we do not have the transmission capacity or the power to generation capacity to deal with all the server farms dealing to produce artificial intelligence. Now the thing is for all of you, if a few of you are aficionados of Star Wars, if you recall from episode 4, which was the first one that came out, the intergalactic war started over a trade dispute. Now, here we have the risk here is we will have our own intergalactic war, likely with China, on trade. And Xi Jinping was on the news today, on the tape this morning, saying that nobody wins a trade war. And he was sending a warning across the bow to President-elect Trump. And the thing is we impose tariffs. Other countries aren't going to sit idly by, and they're going to impose tariff. And you could have a downward spiral, and sometimes trade wars lead to real wars. And so to me, this is a tail risk to the economy, and we have to be extraordinarily cognizant of it, because last time it was like Trump did a light touch on trade. This time it looks like it'll be a heavier touch, and we don't know who will how our trading partners will respond. And my guess is several of them, at least initially, will respond pretty severely, and that could really slow the entire global economy. All right, the other thing that we have is debt and deficits are going to be an extraordinarily big issue. And up until now, no one has been worried about that. They only made lip service to the deficit. But the thing is, this week we're having record Treasury auctions, and this is the projected deficit debt to GDP ratio pre-Trump. With all the stuff that Trump is proposing, these numbers are going to be much higher. So the federal government will be issuing bonds in unbelievable amounts. And currently, debt to GDP with a fully employed economy is running deficit to GDP is 6% right now. And in a fully employed economy, it should be 0 or 1 or 2%. The Treasury designate Scott Bessent wants to get the deficit down to 3% of GDP. That's going to be heroic to try and do that. So my sense is that's another force for inflation. All right. The other thing is what is Trump going to do about the Federal Reserve? Now on TV over the weekend, he said he's going to keep Powell. Powell's term expires on May 15th, 2026. Trump wants is a low interest rate person. He went to war with Powell in 2019 to get rate cuts. If the Fed keeps rates high and there are signs that the economy is slowing, this temporary truce between the president and the Federal Reserve might end, and that could cause all kinds of consternation in the financial markets. So I would view that as a potential risk. Right now, that's in abeyance. Now, as far as the stock market goes, we've been in a roaring bull market for stocks, and this is, if you see the lows in November 20, from November 20 on, we basically almost tripled and tripled from like the low 2000s to about 6,000 today on the S&P 500, and the 20% decline in 2022 kind of looks small. It's just sort of like a little blip, a little sideways moment on the graph, and that was a 20% decline from peak to trough. So the stock market has been absolutely phenomenal, the gains there. Now, Wall Street right now is extraordinarily bullish. On November 29th, the S&P closed at 6,032. I think this morning it's maybe 6,100. You have forecasts here ranging from 6,400 for 7,000 from Wall Street Strategists when I put this together a week and a half ago. But subsequent to putting it together, we have Merrill Lynch coming out at 6,600. We have Wells Fargo coming up at 7,000. And we have Oppenheimer coming out at 7,100. So Wall Street Strategists are looking for 15%, basically 15%, 10 to 15% gain from here. So this is extraordinary optimism. A year ago, Wall Street strategists were pessimistic and the market went up 25%. All of them were uniformly pessimistic and the market went the other way. So this is, I view this as a contrarian kind of indicator because this will be harder to get more bullish than where they are right now. Now the issue with with Trump is the plus is why the stock market took off after the election was the market's very happy with the continuation of the 2017 tax cuts, because otherwise there'd been a significant increase in individual and corporate taxes. More tax cuts are coming. Now, whether they go all in, this is not in the forecast, but it's talking about no taxes on tips, no taxes on overtime, no taxes on Social Security, deregulation, less antitrust, more M&A. So that's why all the Wall Street banks have been going up, because there's a big M&A backlog. There was a merger announced 2 days ago between Omnicom and Interpublic, two giant advertising agencies. That announcement would not have happened if Kamala Harris was elected. There was also a proposal where Mondelez, the maker of Oreo cookies, wants to acquire Hershey chocolate. Now, Hershey said no this morning, but the thing is Mondelez would have never started those talks with Hershey if Kamala Harris was elected. So expect a lot more mergers and acquisitions, and Lena Khan, who's been very aggressive at the Federal Trade Commission, will be out as the chairperson of the FTC. So there'll be a lot more mergers and acquisitions. So that's part of the reason why the stock market had the biggest post-election rally ever after Trump got elected. It's the biggest one ever after an election. The minuses are, we talked about tariffs, deportations, and to be charitable, some cabinet appointments are kind of weak, and that could cause all kinds of issues with potentially Bobby Kennedy Jr. becoming health secretary. The pharma stocks have been weak because he's anti-vax, anti-big pharma. The processed food stocks have been weak because he's anti-processed food, so the market's responding. And the defense stocks have been weak. Also, even given the global threat level, defense stocks have been weak because he's been talking about decapitating the top of the Pentagon. And then you have the Doge Commission with Ramaswamy and Elon Musk talking about how they're going to redo defense contracting. So all of a sudden, the defense contractors are worried about potentially a tighter budget or restructuring of defense contracts. That's a big deal in California right now. That'll affect NASA. That'll affect all the major defense contractors as well. And those stocks have been extraordinarily weak since the election. So that's something that few people were expecting. Now, the problem with the market right now is that all this good news seems to be in. The forward PE ratio is historically high. This is it from 2000 to 2024. We're at 22 times. We're right back to where we were right around COVID, where the market took off and earnings were down. And so we're not doing this PE ratio on low earnings. We're doing this PE ratio on record profit margins and record earnings. We have a 22 multiple. If earnings were very depressed, you could understand the 22 multiple because the market is expecting higher earnings in the future. The last time the PE was this high was at the height of the dot-com bubble. So that is, as an argument for saying is Wall Street wants saying 15% higher. It's unlikely we're going to have earnings 15% higher. So the forward PE ratio will continue to go up if that's correct. But we're at record level here, or near record level. The other issue is the Shiller cyclically adjusted price earnings ratio. And this goes back to 1870. Now, the cyclically adjusted PE ratio is calculated by taking earnings for the last 10 years, adjusting it for inflation. So, for example, in 2016, those earnings would be increased by whatever inflation we had between 2016 and 2024. So they put a multiple, they had 25% onto it, in round numbers to reflect that. And so this P ratio is now at 38.5. It is the highest it's been since, again, the dot-com bubble. Now, this is not a timing tool. It's not, valuation has never been a timing tool. Just because stocks are expensive doesn't mean they can't get more expensive. What the Case-Shiller index tells you is that if you buy stocks at these levels, either using the normal PE or the Case-Shiller PE, what it tells you is the chances of making a decent return over the following 10 years are going to be low. That's the argument. Doesn't mean that stocks don't go down this year, because it's not a timing tool, but it's a long-term tool to estimate what your future returns will be from holding equities. My friend David Costin, who's the chief equity strategist at the small firm Goldman Sachs, put out a paper before, he did it deliberately before the election. And he said, we estimate the S&P will deliver an annualized nominal total return of 3% for the next 10 years. That's in the 7th percentile since 1930. Roughly 1% on a real basis. Annualized nominal returns of between -1 and +7 represent the range of outcomes. We model prospective long-term equity returns as a function of 5 variables: starting absolute valuations, stock market concentration, economic contraction frequency, corporate profitability, and interest rates. And he put this out in October. So what that's saying is, especially for pension plans, if he's close to right, doesn't have to be exactly right. If he's close to right, most pension plans are going to be really underwater, because pension plans are assuming 6 to 8% a year returns from equities. And if it turns out to be 1% return from equity, you're going to be a problem. It'll be a real problem. The other thing is, well, we've all been enjoying our 401ks and our 403bs as the market goes up, is enjoy it while we have it right now, because this may not happen in the future. Now, again, going back when I talked about a timing tool, you see Goldman Sachs, that's David Costin. So he has the market up this year. So even though he's talking about long-term returns, very, very low, but if he gets to 6,500, then what it means, the long-term return is not going to be 1%, it's going to be 0. Because we end this year, then after that, it's tilt game over. So to conclude is, we see the 10-year treasuries in a 4 to 5% range. We don't expect significant cuts by the Fed. Inflation is going to stay above the Fed's target. We'll probably get more volatility than what we used to because of the political environment. Right now, lately, we've only had upward volatility. We'll probably have some downward volatility. So sometime during the year, we're going to see the bulls right and the bears are going to be proven right. We're going to have trade probably in a much wider range than what we're used to. And the high valuations, along with market concentration, where the top 10 stocks are like 35% of the index right now, could lead to very disappointing long-run returns. So on that happy note, thank you so much.
Thank you, David, for that optimism. So we have a little bit of time left before the break, and this is the time for Ask the Forecast Economists your questions, and not necessarily for the three of us up here, but for any of the Forecast Economist teams. And so did we answer all your questions, is my question to you. And if not, raise your hand. Yes, please.
You mentioned the tariffs would increase prices in the United States, but how about if we do more production here because the tariffs makes foreign goods more expensive and the effect on the economy? Did you take that into account?
So the answer is sure. So the tariffs increase prices, which makes domestic production potentially more profitable. And so you saw that with the tariffs on washing machines, for example. And so Westinghouse is producing more washing machines, but it's at a higher price, right? So tariffs have multiple implications for the economy. So that keeps the price from going much higher, but the price is still higher That's what induces that domestic production.
Also a timing difference
Correct.
to get to the domestic production. So we put a high tariff on an import. We have to start making it here, but the factory isn't ready to make it here. So you have a timing difference of a year or two. You still have to build a factory to produce to substitute for the import. You have to build a factory, and there's a timing difference. So you get the inflation in the short run, no matter what, because you can't instantly start producing more in the United States if we don't have the capacity.
Yeah, I mean, that's a good point. In my 20 years in manufacturing, I never saw a factory go up inside of 3 years, up and operational. So there is that timing. Our forecast only goes out 2 years. So we didn't need to take that too much into account for that. But it will induce more domestic production over time. Other questions behind you, Seth?
Are you taking into account climate change, fire, floods, hurricanes, et cetera?
So
That's the answer.
the answer is we will, and we're studying that. Our Mercury Insurance climate change economist, Ji-Yoon Lee, who's sitting here in the front row, is actually studying that. And that's going to be incorporated into our forecast as we go forward. But in the next 2 years, so 2025 and 2026, we don't have the impact of that in our national forecast or our California forecast. Next question.
Just to follow up to the climate change question. So ISO 9001, which is a certification for over 1 million manufacturers worldwide, just was rewritten to that manufacturers now, as part of their quality certification, have to comment on their exposure to climate change as an interested party in their business. So you'll start to see that now in all of the company, private and public, documentation and information.
Oh, that's interesting. Thank you. Okay, who's next? Or have we answered all your questions? Anyone? Yes, we have another question here.
Doge and Elon Musk and Ramaswamy, and you mentioned the cutting defense in military expenses, and now, and which mostly are more in California, that would not have any effect on California real estate.
Well, if you have less, if you have less defense spending in here, it would have some effect on California real estate, but it would be wouldn't be not even close to what happened in the early 90s with the end of the Cold War, when defense was a much bigger part of local output.
And when we're thinking about Southern California, which, in spite of the fact that there are very few assembly plants for airplanes, still has the largest aerospace sector in the country. So expect space to grow. And, for all the problems that Boeing has, they have a huge backlog. Expect them to start delivering airplanes and manufacturing 737 MAXs again. And Airbus also has had issues with respect to supply chain, and Airbus and Embraer, buy components from Southern California. So that would kind of counterbalance that, even if we have some small cuts in defense spending.
No, it's not, and it isn't clear. It isn't clear, what Doge will do, what extent they will do, because Elon Musk is very familiar with defense contracting, and what he did at SpaceX was he totally changed all the rules and made his rockets far cheaper than what United Launch Vehicles, with the joint venture of I think Lockheed and Boeing, and so he understands where the cuts can be made in the defense budget all too well. When I reviewed the book by Isaacson, on Elon Musk's biography, I said it should be required reading for every aerospace CEO and every aerospace board member, because there are ways to making all our defense products a lot cheaper than the way we're doing it now. And Jerry was a part of the bureaucracy in his former life. I was once a part of that bureaucracy in a former life. There are plenty of places where there could be cuts without any impact on the quality of the products being produced.
Just to set the record straight, I was part of the bureaucracy that was cutting costs.
Okay. I was part of the bureaucracy that was raising costs.
But David is right. And so, if we're talking about Southern California, so if the emphasis is on awarding contracts to the smaller startup firms in aerospace and defense, which it looks like it's shifting to, so that benefits Southern California, that benefits Colorado. I'd be a lot more worried in Georgia or Connecticut or Texas, where there are a lot, the high concentration of the larger legacy aerospace firms, and also maybe state of Washington. Okay, we've got just about 1 minute left for one more question over there.
Hi, Professor Jerry. And my question is more on renewable energy and sustainability industry. So next year in 2025, with new administration office soaring in, what do you think, or can you give us more details, ideas on how you guys think these two sectors will transition? Because the attitude is kind of different from the previous administration. So appreciate more lights on those.
Okay,
Thank
so
you.
I'm going to leave that to our other economists. Who amongst our economists have thought about? David, do you have some thoughts on it?
Well, let us say some members of the new administration are climate change skeptics. But the thing is my guess is that the Inflation Reduction Act subsidies for clean energy will continue. And the reason why I think those subsidies will continue is most of that are going to states that President-elect Trump won. Most of those are specifically, call it red districts, with the spending, and there'll be all kinds of pressure to keep that going. Other thing to understand is the #1 state in wind power is in alternative energy is Texas. It's not California in terms of production. #2 in wind power relative per capita is Iowa. Kansas, also another Republican state. I think 70 or 80% of their residential electric demand is coming from wind right now. So I think those tax credits and those things put in by President Biden, because where the money is being spent, I think makes them politically invulnerable to radical and drastic change. So I think the IRA subsidies, by and large, I'm not familiar with every single subsidy in the bill, but by and large, the tax credits, I think, will certainly remain in place.
Okay, so that brings us to the end of the forecast part. We're going to take a 10-minute break. And then when we return promptly in 10 minutes, we have a special treat, which is the Robertson Lecture Series address. And so time to stretch our legs and see you all back here in 10 minutes.
Good to see.
We are ready to start the second part of our program. Okay, it's a great pleasure on behalf of UCLA and the UCLA Anderson Forecast to be introducing the Robertson Lecture Series. And so I want to read you a little bit about the Robertson Lecture Series, that in recognition of UCLA Anderson's role in preparing the next generation of leaders, the Robertson Lecture Series provides opportunities for students to hear leaders discuss critical issues that impact business, society, and the political economy. Made possible by Chip Robertson, who is with us today, class of '06, and his family, and managed by the UCLA Anderson Forecast, the Robertson Lecture Series serves to provide more opportunities for UCLA Anderson students to acquire leadership perspectives and insights. The Robertson family has dedicated these lectures to Leo M. Harvey, 1887 to 1973, a pioneer industrialist and inventor, founder of Harvey Aluminum, and great-grandfather of Chip Robertson. So we are very pleased that the second part of our program begins with the Robertson Lecture Series address by Jamie Montgomery. So Jamie is co-founder and managing partner of March Capital. At March, Jamie focuses on identifying disruptive next-generation technology companies and providing capital at a critical inflection point. He's responsible for leading investments, mentoring entrepreneurs, raising capital, communicating with investors, and building the organization and culture of the firm. Jamie's experience advising a generation of entrepreneurs and financing hundreds of leading technology companies over the last 25 years, and founder and CEO of a boutique investment bank, Montgomery and Company, provided not only a network, but also a foundation for Jamie's pivot to venture capital in 2014. He is also founder of the Montgomery Summit, an annual technology conference since 2004 that attracts over 1,000 global entrepreneurs, investors, and corporate executives, to Santa Monica. Born in Seattle and raised in the Pacific Palisades nearby, Jamie attended Pembroke College at the University of Cambridge, earning an MA in economics, and at the University of California, San Diego, a BA in political science, where he received the Change Makers Alumni Award. And so please join me in welcoming Jamie Montgomery to UCLA. And by the way, Jamie is going to make some remarks, and afterwards, Jamie and our dean, Tony Bernardo, are going to have a conversation.
Thank you, Jerry. Thank you, and it's great to be here. Appreciate the opportunity to deliver the Robertson Lecture. I'll start with comments, and Tony and I will have a conversation. Kudos to Chip and his family for honoring the legacy of his great-grandparents, and I hope to do him justice. 20 years ago, when Chip was a student here, I didn't realize he was still a student. I asked him to join the board of trustees of Westmark School, a school he attended and that his parents had helped to found. A school specializes in educating children with language-based learning challenges, particularly dyslexia. I'd been elected board chair and the school needed a complete overhaul. Chip was on my wing for 8 years, contributing much along the way. I look back in that period with a couple of lessons which I think are particularly relevant for UCLA Anderson's mission to develop transformative leaders. Our stated goal at Westmark was transformation. First, think big. Our goal was to build the best school in the world for kids with dyslexia. It's important in life to have a compelling narrative. I think that's a takeaway today. As you go through life, it's very important to have a compelling narrative. It's even better if it's true. Second, communicate a clear plan. I had recently heard a lecture from a former finance minister of Chile. This was in the celebration of David Booth's 60th birthday. One way to celebrate your 60th birthday is to have a lecture. It wasn't my idea of fun, but David's was. Describing how he had turned around the Chilean economy. It was very similar to what Argentina is going through now. He had asked the president, this former finance minister, he'd asked the president of Chile for 5 weeks of national airtime each Sunday to explain his strategy. Finance minister said this has been very effective. He got on TV for 15 minutes and laid out what he was going to do. Taking a lesson from him, I wrote the letters to the community at Westmark for 5 weeks, addressing the situation we're in, how dire it was, how we're going to fix it, what changes we'd make to the curriculum, testing, student life, the finances of the school, teacher compensation, financial aid. how we're going to fix that. And finally, the leadership challenges. Well, first I scared the hell out of everybody, but we achieved a clear situational awareness and a mandate to implement the changes. Well, third lesson was no matter how hard you try to please, some people are not going to love you or even like you. In fact, a lot of people really didn't like Chip and I. But it's a lesson that's first troubling, but then quite relieving. Our transformation included a complete overhaul of the curriculum and testing. We replaced 70% of the faculty. Maybe we should have gone further. All but one administrator, 100% of the board, introduced new programs in student life, arts, music, drama, athletics, built a new campus, started a financial aid program, obtained full accreditation. As a postscript, we changed the lives of thousands of students and their families. Thank you, Chip, for being there along the way. Thank you for everything else you do in education since then, including founding a major program here at UCLA for diverse learners, the largest one of its kind in the country. So Chip, you've done so much for education. Thank you. I agree with Chip that there's great value in honoring the legacy of your family. 4 years ago, I commissioned a family history, the Montgomerys, with this in mind. To paraphrase Mark Twain, history does not repeat itself, but often rhymes. Often there's a genetic disposition buried in us that drives us. It helps to understand that. And perhaps there's something that's driving Chip as well. I'm humbled to be today's speaker, but I struggle with today's message. I learned many of my lessons the hard way. Are there any shortcuts I could suggest today? The answer is no. So if you want to leave now, you're welcome to. But as Norman Douglas said, and you're welcome to Google him at the end of this, there are some things you just can't learn from others. You have to pass through the fire. Andrew Carnegie, in his biography, lamented that his children would be disadvantaged because they would not be steeled by the adversity that he faced. Often people remark to me that I should have become a venture investor earlier in my life, not realizing that all the quote experiences that I had were what led to my success as an investor. You can't just read a few books, listen to a few podcasts, and go out and do what I do. I started my career in the Pentagon as an intelligence analyst. This gave me a lifetime framework for assessing risk. You know, there was a big risk. Though I give students one piece of advice today, I'd go see my boss in a day and ask if there's anything important I could help them with. No one's followed that advice I've ever given them on that one, but think about that one for a second. I got one of the most incredible assignments in my life by doing that. After leaving the Pentagon, I worked in consulting, learning industry structure, market dynamics, financial metrics, then my life in investment banking, advising a generation of entrepreneurs on strategy, finance, and what to do as well as, more importantly, what not to do. Learn how to convene people to engage groups with divergent goals and to get stuff done. Every year, my knowledge would compound, as would my network. In retrospect, I probably learned more from my failures than my successes, so I guess I was very fortunate I had so many failures. To quote Joseph Campbell, whatever your fate is, whatever the hell happens, you say, this is what I need. It may look like a wreck, but go at it as though it was an opportunity, a challenge. If you bring love to that moment, not discouragement, you will find the strength is there. Now, Joseph Campbell was the inspiration for George Lucas, so it feels a bit like Star Wars, it is. We heard a Star Wars reference earlier. For me, the lessons of maturity at age 65 aren't the simple things of acquiring information, skills, or even building a network. You learn not to burn calories on things that are not important. You simplify life. I learned many lessons from a great mentor I was fortunate to have, Charlie Munger. For Charlie, it was essential to live life rationally and be devoid of pitfalls such as envy, resentment, or self-pity. Think of the 10 deadly sins. Why have envy? You don't get any pleasure out of it. I mean, take a simple idea and take it seriously. He would espouse to anyone and everyone, that's a moral duty to learn and get better every day. His advice was to find super talented people and get out of their way to let them do their magic. He would talk about the seamless web of deserved trust that is so important, because if you don't have that, You can have all these high IQ people, but you're not going to get anything done. Simple scales that we should actively challenge what we think are our best ideas and most closely held truths. That's the hardest thing to do in our business and almost any business. Constantly challenge your own closely held beliefs. Note that all these concepts apply to investing as well as in life more generally. And to always remember your zone of competency. I'm often asked what I think about something, and I say, I have no idea. And people say, you're being modest. I go, no, I'm not. I just have no idea. I really don't have any idea. Just because I'm good at something, I have no idea about this. I learned that you can achieve an elegant simplicity when you remove complexity from your life. And talent, and even hard work are table stakes. The true measurement of success is one's character. Character for us in our organization has been guided by common sense and decency. We don't have an HR manual. It's in the DNA of our organization. When Hamas attacked Israel, we provided support to the families in our portfolio companies that were impacted within hours. When COVID hit, we paid to vaccinate the homeless in Santa Monica. After the looting in Santa Monica, we gave cash grants to rebuild dozens of immigrant-run businesses that had been destroyed within 48 hours, going door to door to the businesses. We also increased further our commitment to inner-city youth programs. This is what we do. We're diverse, we're equitable, we're inclusive, and we're strong in governments, but we do it our way. We don't need to be told what to do. It's in our DNA. And that's firmly how we believe a company should be run. Honesty, integrity, and common sense are essential tenets when we founded March Capital in 2013. We have about 1.65 billion of AUM, about 30 portfolio companies. In 2023, an HEC Paris Dow Jones study ranked us in the top 1 or 2% of 435 funds over the past decade in total returns. Gross basis returns about 25% compounded. And we also have the top performing software IPOs for 3 years in a row. But what we do is not complicated, but it's hard. Our investment approach has been to build concentrated portfolios and continue to double down on our winners. Our operating philosophy has been to do, well, fewer investments and to work more closely with the management teams to help the company scale. Our industry focus allows us to invest in sectors where we have deep knowledge and relationships. CrowdStrike's a high-profile example. Our current focus is on the application layer of AI. There's a multi-trillion-dollar investment underway in AI infrastructure. The application layer on top of this infrastructure will be an interesting area to invest and build companies. And Dean Bernard and I will talk about that today. Samant Mandel is my partner at March, and we have a team of 30 professionals to support our investing, marketing, investor relations, finance, and other operations. And we work as a team. Our venture investments are typically Series A and B, where we target significant ownership. Those are long-term. We look for absolute returns. Most of our money goes into early growth investments, Series B through D. Those take at least 3 to 5 years. And then we have a handful of pre-IPO investments and where we know the companies well. Today, we're navigating a very interesting and challenging venture market. We've had a sharpest ever market correction, the most dramatic technology platform shift, and the longest period of illiquidity. There are massive opportunities juxtaposed to massive challenges. We have a half dozen or more companies preparing for IPOs in the next 24 months, and a number of very dynamic early stage companies. Net's a fascinating time to be investing in growing companies. Within this area, there's a lot of transformational leadership going on. At CrowdStrike, we transformed the cybersecurity industry with an AI-enabled cloud platform. We predicted that all workloads would move to the cloud or would largely move to the cloud. It was a simple notion to capture the threat intelligence and develop what became the world's largest database to understand the threat environment. Then we built a platform, a complementary products or modules on top of the platform. It's now the clear market leader with close to $100 billion market cap. At Cambridge Quantum Computing, now Quantinuum, we built the world's leading full stack quantum computing company. Yesterday, Google announced a company that was far less capability that added about 100 billion of market cap to their market cap. And so I have no idea what we're going to be worth. Generate Biomedicine, we built the leading Gen AI protein therapeutics companies. transforming drug discovery, another project. We're pioneering an area called industrial superintelligence. We're having a lot of fun, changing the world and doing good. Transformational leadership matters anywhere, everywhere, in universities, military, government, not-for-profits, churches, families, family businesses. Good leaders take issues on directly, always keeping the true north in mind. They're flexible on how they may reach the true north, but the goals don't change. The how, the who, and when may. I was with Angela Duckworth, the author of Grit, last week. We spoke about how there's an elegant flexibility in effective leaders. Leaders must respond to the situation and take advantage of the opportunities that arise, utilize talents and resources that are available, delegate, communicate, push down decision-making while maintaining accountability, celebrate success, learn from failures, keep moving towards the true north, and maintain a sense of humor. Angela and I agree that grit's not about being stubborn, but it's about not giving up on the true north. Sometimes people think grit, you just got to be stubborn. No, grit's remembering what the true north is. So I say the majority of challenges in leadership and in life are caused by forgetting what one's really trying to do. The best advice I can give today is to keep it simple. Set your goal as your North Star. Keep that front of mind. Too many people set goals, start to pursue them, then get distracted. We're all guilty of that. You need to wake up every morning and remember what the North Star is. To achieve something meaningful, you need to be selfless and constantly correct course towards that North Star. If we had not stayed true to our North Star at March Capital, we would not be nearly as successful as we've been. And the same is true with all of our portfolio companies. Recently, I had reason to reflect on my legacy. That happens when you have some health issues. Would I be defined by my investments, the companies I've had to help build, or the firm I built, or leadership in the not-for-profit world, literacy, homelessness, youth, church, arts, education, public health, medical research, work, national security, or of course the family? The truth of the matter is, it's only by the grace of God that I've had the opportunity to wake up every day, to live the life with great purpose and rewards. And to the students at Anderson, to all of you, I challenge each of you to live a purposeful and rewarding life. I challenge you to love what you do, to love who you work with, and to be grateful for the gifts that you have been given, and to take pride in the good that you can and will do. God bless you all, and thank you for your time today. Thank you. Tony.
If you want to, why don't you take
Here?
this one here?
Okay.
Yeah, please.
Well, appreciate your time, Tony. Thanks.
Wow, thank you so much for
Yeah.
being here, for giving the address. Chip, I'm looking for Chip. Thank you so much for your support. We really appreciate supporting this series, this lecture series. Thank you for being here.
Well, I got to tell you something, honest. When Annabelle and I decided to live in West LA and set up a firm here originally, being close to Anderson was a key factor for the talent that you have here, that you create here. And so you're welcome.
We appreciate it.
Yeah.
Well, Jerry mentioned it briefly. You didn't elaborate on it, but I'd like to talk a little bit about the Montgomery Summit.
Yeah.
Well, tell us a little bit about who you bring to the summit and the role it plays in the Southern California innovation ecosystem.
Yeah, well, it's got a life of its own now. It's a 22nd year, and we attract over 1,200, 1,400 people now from around the world come, entrepreneurs, tech execs, investors, everything, sovereign wealth fund, family offices, institutional investors, venture and growth investors, most of the leading technology companies in the world, and go-to-market partners. And the secret is the alchemy between, we have 120 companies present, and we have probably 1,500 one-on-one meetings, and probably another 30 or 40 keynote panels, and it's pretty quick pace. No sessions longer than about a half hour, and a lot of household names. And we really try and accelerate partnerships and between smaller companies and larger companies. And sometimes these small companies grow up to be large companies. The first year we did it, we had the Facebook there, which became Obviously, CrowdStrike was an early company. This year, AWS is one of our new partners. I was out with the executive team last week out in Las Vegas for reInvent, and we'll have 20 of their Gen AI companies from their accelerator program here. And we do hundreds of millions of dollars of business. Well, probably, 30 of our companies are built on the AWS platform, which is, obviously a new development over the last decade. But then we do probably $1.5 billion of revenue through AWS with end customers now. So it's a lot about helping companies scale. And so it's just a very effective way to kind of bring the venture ecosystem together. This year, on the day 2, we'll have a theme on national security as well. We'll have some very high-profile keynotes.
Okay,
Yeah.
wonderful.
Yeah, thank you for asking. Yeah.
Yeah. Well, you mentioned you're making investments in AI,
Yeah.
and we're, as a school, fully embracing AI throughout the curriculum. We feel it's an imperative to have our students be well trained on these tools. They're going to complement their own creativity and talents. We think there's, like I'm sure you do, extraordinary potential in drug discovery. You mentioned that, ed tech. What are some of the areas where you see the greatest potential, and what's the impact right now of AI on the economy? There's tremendous investment, CapEx.
Yeah.
What is the impact right now on the economy?
Yeah, well, I think it was kind of understated in the forecast. If not just, it's probably buried in the forecast, but I think it's by far the largest sector of CapEx in the economy is AI infrastructure. We forecast it to be about $1 trillion over the next 5 years, and we're way off. It's probably at least 50% more than that. It'll be $300 billion next year of AI infrastructure in the U.S. And it's probably at least 35% of all CapEx in the S&P 500. So it's larger than the next 3 categories of CapEx combined. And so I think AI infrastructure spend is really bailing out the economy, that and government spending. It's by far the largest areas of CapEx in the economy. And so what does that mean? Well, so what we look at is every IT cycle, you have an infrastructure spend followed by an application layer spend. And so, that infrastructure spend is largely by the hyperscalers, AWS, Microsoft, Google, and to a lesser extent, Oracle and IBM. And they're building out data centers and other capacity. Then what follows is the applications that are built on top of that that lead to productivity. So we focus on 3 areas within that, what we call automation, which is all the productivity tools. And we look at what we call vertical software, which a lot of that is we call it services software, which is basically like legal, call center, supply chain visibility, insurance claims processing, where you're taking human capital and pretty much putting the human behind the technology rather than in front of the technology, and you're really in improving the quality of the work that's being done, and probably the pay of the employee, and the it's just a win-win all the way around. And then the third area that we refer to it as discovery, where we're doing things that you couldn't do before using AI, because Gen AI allows you to do things that you couldn't do before. You think about scientific discovery. I mean, you look around a campus like UCLA, there's probably about $1.5 billion a year done on campus in scientific research, funded largely by the federal government. And it's really a collection of smaller projects, right? It's like a real estate agents, all these little projects. And it hasn't changed really in decades, right? These little projects working together. But you think, and that's how scientific discovery has been done for the last several hundred years. And you think in the age of generative science, if you do something 1% better 1,000 times, or anyone here who does compound interest will know that's 20,000, right? Okay. And if you can apply concepts of generative science, and you can get that impact in generative science, so if you can do that over here in the chemistry department, or in material science, you can get something that's 1,000 times more effective at carbon capture, or a material that's 1,000 times more effective. And so what we're trying to apply are some of the laws of AI, generative AI, into some of the other areas of the economy where we're using generative science techniques for discovery. We have a science factory that we're building in Cambridge, Mass, and it's made a $200 million seed round there. Really fascinating. And I think there, we could change the way scientific discovery is done in the world, it should be different. I mean, why are we doing things the same way we did them for the last 100 years? Doesn't make any sense. And then we did that in drug discovery. We have a company we built there. It's Generate Bioscience. We have a partnership with Amgen, which, a lot of that came out of UCLA. Tony Rebus is on the science advisory board here. He's just down the street here. We fund some of his research personally here. And he's a very famous doctor. He's the one who's treating Jimmy Carter. If you guys don't know who he is, you should. He's developed Keytruda. But how will future drugs be developed at Amgen? We'll be using generative AI. So we have like 15 drugs. We're also partnered with Novartis there. And I think we have 16 drugs there in develop there. We have another company, we're using Gen AI and mRNA technology to do gene rewriting. So a single injection, we can rewrite your DNA to eliminate diseases at the base level. And the last one was kind of cool for MBA students. This is great. We partnered with the fellow who wrote the original paper at Google on transformer technology, general purpose transformers, which everyone knows the short version of that, GPT, Ashish Vaswani, a wonderful fellow. We started a company with Google, NVIDIA, and AMD. I'm the lead investor there. And we have a product there which you can do query or reasoning, and you can with natural language, and you can ask it questions, and we're training it on all the venture data. So it will eliminate the 100-hour work weeks in investment banking. So, because we'll do all the analysis for you, right? It was fantastic, right? I mean, well, why is anybody doing a 100-hour work week in investment banking? It's just monkey work, right? Yeah, it really is. I mean, come on, I did it. I was like, Jesus Christ, this is not ridiculous. And so we're training it. McKinsey's partnered with us and others, and we're training it to do. It's an enterprise brain. So we built a 12 billion variable model that does this stuff, and so that area we call discovery. So we're saying automation, vertical software, and discovery. Those are the areas that we're focused on. So massive opportunities across the economy, but there's this, $300 billion of infrastructure spend, but the real area is going to be in the applications built on top of that. I hope I answered the question, but I'm super excited about it. But it all comes down to training human capital to use it.
We're hoping to do that.
Yeah.
Yeah.
I mean,
do you have a perspective on quantum, when it'll be ready for real commercial
it's
opportunity?
I think 3 years. Yeah, 3 years. Yeah. I mean, there are some apps that are going to start using on it now. Quantinium has, we're doing some things. 2 years is probably too short. Jed, what do you think? 3?
3 to 5 sounds good.
Yeah.
So UCLA is making a good bet with the quantum investment and research park.
He's a Anderson alum, Jed. All right.
I want you to weigh in on, I know, sort of something of a sort of, I wouldn't say controversy, but debate about, new ventures and the importance of the idea versus the founder.
Yeah.
The horse versus the jockey.
Yeah.
How do you sort of come down on that?
It depends.
And what do you look for in entrepreneurs?
Oh, we love entrepreneurs to scale, but oftentimes you just, it's hard. It's really hard. It's hard. It's the question really is how, it's really about the transition from an entrepreneurial run company to an entrepreneurially inspired company, right? And can the entrepreneur scale? Can the entrepreneur attract? Can they develop? And can they attract, retain the talent around them, to take that next step? And there's different models. There's no one size fits all. We've seen, tech founders who transition into being a CTO founder type and let the management team run with it. And that's worked really well. We've seen founders just grow and just be incredible. I mean, sometimes you're a little bit more mature. Maybe they had one startup, and the second one, like George Kurtz, has just been amazing at CrowdStrike, and maybe he's, the exception, to the rule. And we've had others who just kind of hit a ceiling, so it's really hard. Oftentimes a founder led company actually gets a higher market multiple, they kind of like that, so, for some reason, the public markets like the story, it's kind of, when in fact, maybe you're better off with a professional CEO, so like, oh man, so it's a tough one. It's a hard one. We prefer to stick with the founder as long as we can. Sometimes we maybe stick with them too long, it's a really hard one, but it's something, we're always probably the closest confidant of the CEOs on the boards that we're on. We're usually the lead investor in the rounds that we're in, and try and have the closest relationship so we can have these conversations. You can't have the conversation unless you have the trust. And you want to be helpful, but it's hard, it's hard, and they have to have the team around to be successful. It's never one person. It's like, oftentimes you can really help an entrepreneur scale. They have a strong CFO, and having them understand what a strong CFO can do to offload a lot of their job, and then transitioning, other team members, maybe this founder was wearing hats. Maybe they're wearing the engineering hat or the product hat too. We have that sometimes. They wear too many hats, because they're good at it, right? Doesn't mean they should be doing it though. So it's a complex conversation, but you got to kind of sit down with each of them really. If they trust you, I ended my comment talking about love what you do and love the people you work with. And they don't think that, your heart's not in the right place. They're not going to trust you, And that's so important. And I know you're probably thinking, is this guy corny or something? But if you really sit down with an entrepreneur and they really believe that you care about them, you might be the only person that does outside their family, I mean, let's be honest about it. It's a very interesting dynamic. And the consequences of that are massive trust, ability to invest in companies at a much lower valuation than anybody else, and ability to control the cap table, Why did you get 17 times the pro rata in CrowdStrike? How did you get in that deal when they had 6 higher term sheets, Oh, yeah. CEO loves us, we love that, And you're thinking, this guy's corny. This guy's a very smart investor. Yeah. Okay. I mean, you got to really care. So you look after the CEO's family. He calls you all these times about all these other issues. Oh, hell, of course I do, Yeah. I mean, you really got to care about who you work with. The job doesn't end at 6 o'clock or Friday evening or something, This is, you're with these people for 5 years, 7 years. You're all in. You got to do everything possible you can to help them every way, personally, professionally, family. Any comments from my team on that? Or I mean, right?
Yeah.
I mean, it's you're all in, right? And that's it has to show, and that's, I don't know. Did I answer your question on that?
Absolutely.
Yeah. And that's, it shows. I
I'm
mean, but
rethinking my leadership.
yeah. Well, I mean, people do extraordinary things for you if you do extraordinary things for them, Yeah.
I'm going to switch gears a bit
Please.
because you served on the Simpson Bowles Commission.
Yeah.
That goes back a while. And since then, for those of you who don't remember, that was the last, most recent, hopefully not the last bipartisan attempt to rein in the debt. Since then, the federal debt has more than doubled.
Yeah, maybe tripled.
And maybe even tripled.
Yeah.
And the prospects going forward for continued deficits and growing debt are pretty significant. What are your thoughts on the path of the deficit, growth of the debt, the eventual impacts potentially on the economy and the markets?
Yeah, no, it's important. The Maya McGinnis was the executive director of that. We still have the the Committee for Fiscal Responsibility, so we kept the staff going. It's supported privately and to do the research, and that's a lot of people take their budget data projections from that committee, and this was Obama was the president. It was a bipartisan, Jamie Dimon and Jeff Immelt was CEO of GE at the time, and Eric Schmidt from Google with the 3 chairs. And Erskine Bowles had been Obama's chief of staff, and Alan Simpson was a senator. And they had a bipartisan commission, about 20. There's like 2/3 Democrats, 1/3 Republican. I was one of the Republican appointees to it. It's interesting. Senator Thune came to see me about a month before the election. He's now the Senate Majority Leader. I hadn't realized what a big deal he was. And all these black SUVs show up, and they've got, oh, geez, it's a serious meeting, and you look at it, 2019 tax revenue was 3.5 trillion. 2024, it's 4.7 trillion. So it's not really a tax revenue issue. It's really a spending problem. Tax revenue's gone up. People talk about, oh, we cut taxes. Well, look at the revenue, right? It's gone from 3.5 to 4.7 trillion. That's a lot of revenue, right? It hasn't really, what are we talking about here? We had a lot of revenue. I mean, the rate went down, but the revenue went way up, and the revenue is continuing to go up, right? And we just have a spending problem. And I think this administration is going to try and get its arms around spending, and it's hard because they're going to have to balance, some issues regarding border. They're going to have to figure out how to reallocate some defense spending. They're going to have to deal with some issues. It's going to be really, really interesting. There's an opportunity to cut spending 5% a year for 4 years. You balance the budget, And I think they're going to have to go after it. And I think, it's what we should do. Someone earlier talked about looking at somebody on a diet. I mean, we have it's like you have a 325-pound person coming through the door, and we're arguing whether or not they're fat or not. Whether they weigh 350 or 300, we're arguing about it. No, we can cut 5% a year without any problem, right? That's what we have to do. Let's do it. And I don't think we're going to have a bipartisan commission. I hope we have some sort of bipartisan agreement. How we get there or not, are there some places we can raise some taxes to help increase, but I think we've had pretty good healthy tax revenue. I got to figure out where we can have some savings. It's probably got to come out of entitlements. Probably got to spend defense money better and get some efficiency. It's got to be everywhere, I think. It's going to be interesting. I think California is even a worse situation. A $60 billion deficit last year, $30 billion deficit this year, $20 billion additional unemployment insurance. UC is going to get really hurt. It's going to be, and all this are really, unnecessarily, ambitious spending plans by a very progressive government. When you have a record tax revenue, they just amped up the spending and haven't dialed it back, and they just pushed out any hard decisions, and we've had it both at a state and national level, and we're going to have to pay for it. And I think it's, if I was a generation younger, this is a chance. We talked about transformative leadership, and I think a number of people, if you're, listening in and you're, a young leader, this is an opportunity to get engaged. I think, we're going to have to deal with these issues, as a society. We got to figure out how to take 20% out of our state budget. No question, it can be done. All right.
I'm gonna ask.
I hope I don't get you canceled.
Well,
Every chancellor in the state
yeah.
thinks that they can cut 10%, no problem. But the unions would just go nuts if they did, right? So you have to go back. After the Cold War, we had something called the Base Reduction Act, called BRAC. And it passed through Congress, bipartisan. It was like up, thumbs down. You couldn't change it at all. Passed unanimously. Very successful. You almost got to do something like that. Here's the plan, thumbs up, thumbs down. Because once you start playing with it, politics come in, right? It's hard, right? All right, sorry, Jerry.
No worries. I'm going to ask one more question because I want to make sure we leave time for one or two questions from the audience. So again, a little bit switching gears. You talked about the range of causes that you support philanthropically. Tell us a little bit about how you prioritize and how, given particularly what you talked about earlier about your leadership style, how do you find the time to be engaged with all of these different philanthropic efforts?
Well, look, I think leadership's important. So we commit, my rule of thumb, and encourage people to look at your, you get to a certain point in life, you've done well, you look at what 1% of your net worth each year and give it away. And, I mean, probably when I was younger, we did a lot more than that, but, and at least 1% a year. And we look for excellence in leadership and where we can make a difference. And what we do is really inspire and convene. We convene other people, we inspire the leadership, we inspire others to get behind us. And, we have a lot of energy and we do something people think, all right, we'll get behind that. And so we probably do, things that are important for us are youth organizations. We're a big believer in, values. Where in the world are you going to be learning values soon? I mean, faith-based values organizations, and so that's very important to us. Providing educational access and opportunities, homelessness and hunger areas. Do a lot with UCLA and medical research. We've had some huge breakthroughs here, massive breakthroughs here at UCLA. Really world changing. So it's great, but it's about, we're able to convene people, inspire them, work with the very best, and provide, real resources that make a difference. And so it's been great. How do I choose? God, I don't know. It's, only, and then bringing my 4 kids involved in that, and people help me in the family office, and, don't ever compromise on quality, and, and always, if they say we're going to do something, it's like 100% sure it's going to happen. If I commit to something, it's going to happen. My word is like, people say, yeah, it's going to happen like within 24 hours. We went door to door in Santa Monica rebuilding businesses with cash. The bank branches started, thinking I was a drug dealer or something. It's like Korean-owned business or Indian-owned business, Mexican-owned business. And I got wiped out. Handing out envelopes of cash. What had to file these forms at the bank. What was I doing all this cash? Pretty funny.
That's wonderful. Well, thank you.
Anyway,
Thanks so much.
hey, thank you.
Yeah,
Thank you
no,
for
appreciate
everything
it.
you guys do.
Yeah,
All
thank you.
right.
But we want to get a couple of
right,
questions
all right,
in.
go
Yeah,
ahead.
so please, yeah. I don't know if we need a mic or if you can just project.
Project.
Inspiration, it's kind of a drug dealer too. I mean, inspiring people. It's kind of, when you started, you said that going around Santa Monica. And I had a question on cryptocurrency and Bitcoin and all these talks that through Bitcoin adoption and making a treasury, a reserve, there is a path to elimination of the
Currency?
the budget, the national deficit. Any thought on that?
No, I really don't have anything to, what did I say earlier? Some things I don't know anything about.
That's
That
one of-
falls in that category.
Okay.
Yeah,
And so you stay away from it.
I stay away from that
Yeah,
one.
yeah.
Yeah.
I-
Yeah, here we got
yeah,
one over
yeah.
here.
Yes, please.
3 to 5 markers or signs that it's time for a founder to be pushed out of the CEO role into a CTO role or something else, a supportive role, and have them be replaced by a professional manager or a professional management team.
Yeah, well, the question is when are the signals of, time for a change? And, oftentimes it's, the CEO is, maybe distracted. You're starting to miss milestones. Turnover, can you get the product out? Turnover, customer churn, I think those are probably some of the ones. I mean, so it's hard sometimes, you're sitting there and you're at a board and you're not really getting, it's hard for you to know, exactly what the gross margin of a certain contract is. I mean, how do you get insights? You can walk around, you know, go see customers with them, you can do interviews of the other execs, you know, you try and spend some time at the company, during Zoom it's impossible, right? You know, you like to go on customer calls and see what's going on, get the feedback, observe the SDRs and how well trained they are. I mean, you gotta, you know, go to their sales kickoff. You know, you guys just see how well run it is. Is it a well run shop or not? Yeah, I mean, you know, it's you really have to kind of get under the hood. You know, good question. If you're not under the hood, most people have no idea, to be honest, because they don't do the work.
We're gonna.
Well,
have to
thank
stop
you.
there. Yeah, thank you again, Jamie.
And best
Yeah,
wishes to the
yeah.
holidays for everyone. I mean,
Thank
I
you,
gotta
Jim.
say one thing about this time of year, which is great, is we always call up our best clients and investors this time of year, and you know, tell them how important they are to us, and you know, our CEOs and our investors, and you know, it's just those things that you notice who your best CEOs are, because they just have that innate ability to relate to people. They get it, you know, they're on top of it, you know, and this is the time of year where you can really tell who's on top of it and who isn't. Yeah. So thank you.
Wonderful.
All right.
Thanks again.
Okay, you're welcome.
Okay.
Okay, thanks. Yeah.
So a big thank you to Jamie Montgomery for those insights, to Dean Bernardo for moderating, and a special thank you to Chip Robertson and the Robertson family for the Robertson Lecture Series in honor of Leo M. Harvey. Now we turn to our expert panel on financial markets, and I want to invite the panelists up. I'm going to introduce the panelists, but they have deep expertise, and if I did a thorough job of introducing them, they wouldn't have any time to speak. So this is going to be very short, but I urge you to read their biographies. So if the panelists would come up to the front while I'm doing the introductions. So the first panelist is Ken Broad. Ken is founding member of Jackson Square Partners, and he is the co-chair. He holds a bachelor's degree from Colgate and an economics MBA from UCLA Anderson. Second is Richard Farber. Richard is an adjunct professor of finance and investments at the School of Advanced International Studies at Johns Hopkins University, and formerly held senior positions with the International Monetary Fund. And he holds a bachelor's degree from Franklin and Marshall and an MBA from UCLA Anderson. And Mark Greenblatt. Mark is Distinguished Professor Emeritus from here at Anderson. He did his graduate studies at Yale University. He was the Japan Alumni Chair here at Anderson, and as Senior Associate Dean, was running our PhD program at Anderson. And our moderator for the panel is Lori Sentikian. Lori is Adjunct Associate Professor and is Faculty Director of the Fink Center for Finance, who is co-sponsoring this event with us. Lori has her BA in Economics and Finance from our sister institution, UC Berkeley, and a PhD from Harvard. And now I'm going to turn it over to our distinguished panel and Lori.
We are delighted. We always look forward to this collaboration with the forecast. And so we're really thankful to Jerry and his team, to Jamie and Dean Bernardo for all of their insights. And as Jerry mentioned, now we have an opportunity to hear from a panel of distinguished experts on their outlook for financial markets. Sorry for the echo. Okay, So let's start with the big picture. So you're all highly seasoned in finance and have been analyzing markets and participating in markets for a very long time. What do you see right now in terms of what has been consistent about markets over time, and what do you see as changes today that you haven't seen before in sort of the way that markets are operating? Rick, if you want to
Okay,
start.
yeah, sure. So thanks, Lori, and thanks to the Anderson School for having me here. That's an excellent way, I think, to start the conversation. So in order to figure out what's going to be different, start with what's going to actually remain the same. So for illustration purposes, right? So there's 3 points, and for illustration purposes, and I promise this will be my longest answer of the panel. I'm going to refer to Executive Order 13772, which just to refresh your memory, this is what it says. It comes from the president and the executive office, and it puts out the core principles to the US Treasury, right? And so here's just some takeaways from it, which is empower Americans to make independent and informed financial choices, save for retirement, build wealth, foster economic growth, vibrant financial markets, enable American competitiveness, prevent taxpayer-funded bailouts, make regulation efficient and effective, ensure a financial system is resilient to economic shocks. So if I asked you what year that came out, right? And what administration was that? A Democrat administration? Was that a Republican administration? Without asking for a show of hands, I think it would be hard to actually tell which administration put that out, because those are objectives that you'd want to be true throughout any period of time. So as it turns out, that was issued in February of 2017. So that was the first Trump administration. So if you're looking to see what the second one would look like, that's a reasonable starting point. And so you can see that, you know, the objectives are going to be the same. The tactics to get there may end up being a little bit different, but the destination will ultimately be the same. So that's point one. Two, what else has been consistently true throughout our careers, right? So if you take the beginning of the modern bull market, which you say 1982, which pretty much encompasses everybody in the room's investment experience, what things have been true throughout that entire period of time? So one is buy the dips, right? There's never been a time when if you actually bought what looked like a horrible situation, a terrible piece of news, a big drawdown in the market, that you didn't get higher prices again sometime in the future, sometimes quickly, sometimes not as quickly, but progressively higher. So buying when the market sells off heavily has always been a good strategy. Two, American buy US. So now the popular phrase is American exceptionalism. But it's more or less pretty much every period of time since 1982, if you had bought US, you would have outperformed a basket of the entire world or anything in an international market. And in fact, that exceptionalism, that difference is actually greater now than it's ever been. It's at a 75-year high. So it's only widening, actually. And then the third is, and this pains me to say it, but passive versus active. So I've spent pretty much my entire career in active management and absolute return, but it's been hard to argue that on average, with clearly some differences and exceptions to the rule, buying an index or buying a passive portfolio has been, and just doing that consistently has been an outperformance strategy. And all three of those, at least for the near future, looks like those will persist. It doesn't look like those things will change.
What do you think might change?
I'll come back to those.
Okay, that sounds great.
Okay.
Mark, would you like?
Yeah, I mean, I agree with all of these sentiments. I was there for the start of the bull market, sitting at a lunch table with one of my senior colleagues, who, after watching what happened to the stock market in the 1970s, decided one day he was going to take all his eggs and put it in the stock market that day. And the next day, the bull market started. That's the story of luck. And one of the things I think that's been constant about the financial markets is they've been very competitive. And as was just mentioned, it's incredibly hard to make more money than the average person. You make money by taking on risk, but you also risk something when that happens as well. And markets are as competitive as ever, and as hard as I try sometimes to quote unquote beat the market, I inevitably find that if I do beat the market, it's usually over a long period by a very small amount or not at all. That competition remains. That doesn't mean you shouldn't be invested in stock markets or bond market. It just means that if you want high returns, you're gonna have to take on risk. And yes, returns have tended to be higher when we've seen the dip. Of course, we're looking with hindsight at a 45-year bull market almost. But it's also the case that when prices dip, volatility goes up. So you are taking on more risk, and at least theories in my field suggest that the premium, or at least the premium you get on the market, ought to be proportional to something like the variance, the square of the volatility of the market. So when there are dips, it's perilous too, and there are all kinds of examples of other countries where you lose money. But that said, I think you should be invested in the market at all times. And if you want to vary your proportion one way or the other, probably the times to do that really depend on your appetite for risk and whether you want to take that on. Some people can afford it, other people can't. What's changed? It's become almost free to trade in markets. This going back 45 years, you tended to buy your shares in larger lots. You wouldn't trade too frequently because it was expensive. Those costs have come way down to the point where for a retail investor today, it almost costs nothing to buy or sell stocks. So I have always been puzzled by the adage among active investors, buy, sell, hold. I sort of think with costs of trading so low that every night it's kind of like you decide, even if you don't do it, to sell your entire portfolio and buy it back a minute later. You're always making that decision about what you want to be invested in. So I think the big change has been the cost of trading. And that's, of course, engendered a lot more trading volume. But what the implications are for the future returns of the market or the volatility of the market is still an open question.
So, sorry. Ken Broad, I started at Anderson. Mark was actually one of my professors. I was there 92 to 94. Shifted from investment banking into investing, went to Franklin Templeton Group, really saw the whole range, small cap value growth, everything. And I had been steeped in kind of fama French, small and value was how you outperformed. And so really focused on small cap stocks, intrinsic value, did well for quite a while. The last 20 years has been literally the inverse of that. So large has outperformed mid has outperformed small, and growth has massively outperformed value. And so the big trend that I see in the market, which is actually kind of petrifying because it's autocorrelated, is the increasing concentration. So Barron's had an article 5 years ago saying, oh, isn't this dangerous? We have all these passive flows through just 3 firms. I said, it's worse than that. You have passive flows through 3 firms into a handful of stocks increasingly. So for the Russell 1000 growth at the time, the top 5 stocks were 27%. They're now 47%. And the S&P similarly has gone from like 15 to 28% in the top 5 stocks. And so these are not diversified portfolios. It was actually alluded to in the first presentation, Goldman Sachs, David Costin, on one of the risks. And interestingly, from a forecast perspective, it also flows through to California, because California is basically a giant levered bet on the stock market and tech stocks in particular for revenues. So it's been great. But I see a lot of risk in that concentration, both at the state level for revenues and just everyone's 401k.
So you mentioned risk. Obviously, that's a hot key word as we think about financial markets. And we've heard a lot about headwinds today. What do each of you see as the key risks in the market going forward? And how should investors and institutions be thinking about their portfolios? Whoever would like to start.
Well, I think the biggest risk is political forces. And what's changed in the last 1,000, 2,000 years is that the population of the world's developed economies is really starting to age. And with that is going to come all kinds of political pressures from populations to take care of us, to take care of the aged, and it's already incredibly expensive. We had discussion in the previous session about deficits, and we've got a huge deficit in these entitlement programs in Social Security and Medicare. And all around the world, pressures to keep that going at least at the current level of benefits or even higher is going to continue. And that's going to create distortions in the incentives people have historically to run businesses efficiently, to create wealth, and so forth. So I think the demographic challenge it's less of a problem in the United States than it is in many other regions of the world, in China, South Korea, and in Europe, for example. But I think you're going to see geopolitical tensions, and you're going to see political forces that may cause disruptions to normal economic progress because of this change. And we're only going to get older with all these new drugs that are being invented as well. And the question is, how do we make the society productive when most members of society are really spending their time going to the doctor, or worse yet, going to the hospital?
So yeah, I would have to agree with Mark on that point. When I look to see where's a good place to go, someone who's done good work on what risks are in the economy and in the market, FSOC, the Financial Stability Council, that looks for systemic risks. That's part of the government, different government agencies that are together. They put out a report, and they just put out one in the most recent annual report in December, and it's very comprehensive. It really touches on everything that if you wanted a long list of what looks like risks, but if you wanted to put magnitude on it, none of them really seemed that dire, which leads me to what I think in a more immediate term, what the three risks of the market are, and that is 3 C's, which is consensus, complacency, and compression. So consensus, if you look at the numbers that people are expecting for whether it be growth or market returns for next year, they're pretty tightly clustered, right? There's not a lot of divergence. There's generally an expectation, and the expectation is 100% all positive returns. So it's a pretty narrow band of what expectations are for next year. Complacency in that consensus creates complacency, right? So it's like you feel comfortable because everyone around you thinks the same thing. And in fact, for the most part, 2024, the results have been so good, almost every asset class went up, that there wasn't a lot of reason for alarm. And then third is compression. So compression in the valuation of certain asset classes. So if you think of credit, right, credit spreads are incredibly tight. And if you think of equities, multiples are high, not that they can't go higher, but they're high. So you get to an potentially asymmetric risk return where it can't get a lot tighter, but it could get looser. And so that's the way I think of like the risk is more in the mindset than it is in any one actual component of the economy or financial markets at this point.
Okay.
Yeah, complacency and consensus, I think, are big risks. The demographics issue is absolutely fascinating. There's a great book called The Great Demographic Reversal, which talks about people living longer, but all the neurodegenerative diseases still kicking at the same time. And so you have a lot more Alzheimer's patients, dementia is all very expensive and inflationary. And so Elon Musk has been ringing the bell about this quite a bit, the fertility crisis. And because it's slow moving, people are just not as aware of it, but it's just math. You can predict it out pretty well. So what excites me looking out are markets like Argentina, where you have Javier Milei really, providing a complete revamp to that economy rather than having it flop around like a dead fish that it's been, despite its underlying potential. So we'll see if he makes it through to fully seeing all the reforms implemented. But that stock market has been on fire because, again, it's a discounting mechanism and there's optimism around positive change.
Mhm.
So, yeah, so complacency, I think, is a big problem, and people need to look at the looming problems, and there are a lot of them.
Mhm. It seems like that's always true, right? These are sort of risk factors that are always salient. And if we think a little bit about the immediate term, especially as we head into a new administration, Mark, you mentioned deficits. I know Jamie didn't want to talk about deficits, but would you like to talk more about deficits and, just more on the fiscal side, deficits, trade policy, tax policy? How are you thinking about all of this? No one wants to talk.
I have some sales about everything. The deficit problem is, I mean, Elon Musk notwithstanding, the cost efficiencies that he established at SpaceX and at Tesla, and I'm not going to talk about X, it's controversial, are remarkable. But the real elephant in the room is Medicare. I'm on Medicare, so I don't want to see my benefits cut, nor does anybody else. And I don't know exactly what the number is, but the unfunded liabilities for taking care of the elderly, I think, are well over $100 trillion. So forget about these $35 trillion numbers. How are we going to come to grips with that in a world where the population is going to live longer, especially now with these GLPs coming out? It used to be that you thought something like that's going to reduce healthcare costs. They thought that about banning cigarette smoking, but in fact, it increased healthcare costs because people live longer. We're going to have that cost to bear, and I don't see a good solution for economies around the world to get out of that unless the technology of AI brings us remarkable growth, or unless central banks inflate their way out of their deficits. Neither of those are good solutions. And a lot of the problems are also connected with the economy. So one of the reasons we have a fertility crisis is that real estate's so expensive. And, young people, and you can see this in various parts of the world where you don't see, much hope or an entrepreneurial class developing among young people, it's because they're just waiting for their parents to die so they can inherit their apartments in Europe and Hong Kong and all these other places. We have to find incentives for people to actually have kids. And
Joy, right?
The joy. I have 2 kids. They are joy. But the Gen Zers are not focused on that right now. And I think part of that's tied up in the economy. And they've changed their value system as a consequence of lack of hope of being able to afford a home in a city. Now, maybe if you can live in a remote part of the country, real estate's cheap, that'll solve the problem, but time will tell.
I'll touch on one of the points that was made in one of the earlier presentations, specifically to tariffs and tariffs vis-a-vis inflation. So first, inflation, it's an average number. It's an amalgamation of a lot of different components, and really needs to be thought of more like a utility curve, which everyone has their own utility curve. Inflation, everyone has their own inflation, right? Like, for instance, Ken and Mark may be more sensitive to the price of books going up. I'm very sensitive to the price of Clipper tickets actually going up. But you actually saw it exhibited, the difference between the economics of it and the reality of it in the voting from the last election, which was, economists would have said that inflation was somewhat benign at that point, but yet individually it was expressed in a completely different way. So, okay, if you make the assumption, right, and that's still a leap, but if you make the assumption that tariffs result in an increased inflation, well, why do you have the tariffs there in the first place? One reason is national security, to increase national security, bring your supply chains back home. And 2 relates to employment. So that would be an increase in the total amount of employment and the increase in individual wages. So to the extent that, if possible, right, one scenario, that the aggregate of those 2, an increase in wages, is greater than the rate of inflation, then it's not necessarily a negative thing that if inflation actually went up. Third is the trade-off. So again, let's say hypothetically inflation goes from 3% to 4%, right? So no one's happy about a 1% increase in the CPI number, right? But what do you get in exchange for that? So if you get military security, if you get technological security, if you get an increase in economic security. Well, then you have to decide, is that 1% worth all those other extremely important but more intangible type items? So it's really like, even if you do make that assumption, you still have to look at it really holistically as to like the pros and cons.
That's a really important point. The world has always been better, faster, cheaper. Part of the reason we have 90% of high-end chip manufacturing on one island off of China was for cost, but there's a huge negative externality around security and volatility that was not taken into account when those decisions were made. So unwinding that, the demographics, you have all these pressures on inflation. I'm a big fan, Ray Dalio's book, The Changing World Order, I thought was excellent. And his advice is you need to be broadly diversified and prepared for inflation. And so you can look historically, real estate, equities. You don't want long duration fixed income, but generally being broadly diversified. He even entertained crypto and I think gold. And so you just have to have a wider aperture on a different environment that we've experienced over the last few decades.
Mm-hmm. And what about on the monetary side? How are you thinking about central bank policy around the world and especially, of course, here in the United States?
So I think there's been 153 rate cuts across the world in 2024. And the expectation is that there'll be about 125 next year. But I don't know that there's anything as equally transparent and well telegraphed as rate cuts, right, intentionally. And it could be possibly the most discounted and already in the market component of what's out there. So for that reason, right, like it'll be what it'll be, and expectations are pretty clearly in place. And so I actually find like the time spent talking about the Fed and the Fed policy and where rates are going is probably not the best use of time. I mean, it takes up a lot of time on CNBC, but I think that time could be better spent because those numbers are pretty out there and fully discounted.
Yeah. Hard to follow that, right? If you're saying don't pay attention. Right. Okay. Well, what about on the geopolitical side? We think about, Russia, Ukraine, US, China, the Middle East, anything that you're thinking about in terms of the role that geopolitics is playing in the current market outlook?
I'm amazed at how markets shrug off geopolitical concerns. Maybe it's the old adage from Warren Buffett that, if somebody told you that there were 50 nuclear missiles headed towards the United States, what should you do? And his answer was, put it all in the stock market immediately. Because if the information is wrong, stock market will go down and you'll be making a fortune because you'll be buying these stocks at low prices. And if the information is right, who cares? And that seems to be the way the market has been taking, tremendous geopolitical tensions around the world. China's been extremely aggressive in the last few years. There seems to be an unholy alliance between China, Russia, Iran, North Korea, and perhaps Venezuela. On the other hand, very recent events have suggested that unholy alliance has been greatly weakened. And markets seem to get through all of these things. They got through World War II, they got through the Cuban Missile Crisis, they got through everything, and they probably will get through this set of tensions as well. It seems to be whether businesses are making profits or not that matters. And CEOs and their corporations have been remarkably resilient through all kinds of trying times at making profits. I mean, I've been amazed through the Great Recession or Great Depression, whatever you want to call it, of 2008, 2009, through COVID. These were very short-lived blips in stock markets and the economy. I mean, when I think about a real recession, I really go back to the early 1980s, which was long-lived and took quite a while to wring out of the system. It's almost as if financial markets have become so liquid these days that they are cushioning whatever might be happening in the real economy that used to cause tremendous dislocation, tremendous unemployment, you know, throughout much of modern economic history. That doesn't seem to happen anymore. I mean, you can call 2008, 2009 severe. You can talk about all the restaurants that closed during COVID and the travel businesses that were hurt. But we're really talking about months for these, what would previously be quite severe events, and they don't seem to have the same impact anymore. And one theory is it's because capital gets allocated so efficiently these days and so quickly that it cushions the effects that on the real economy that would otherwise happen.
It's also the case that a lot of companies are both digital and distributed. So we had one company headquartered in Tel Aviv, Wix, but it's a virtual company essentially. People work remotely, they have headquarters all over the world, and their business is a recurring revenue type model, and so very resilient. And again, contrast it with World War II or something where a factory gets bombed, like the factory's not putting any product out. So I think that's another buffer.
What are you thinking these days about regulation? So again, as we head into a new administration, how do you think about the regulatory environment, especially for the more emerging technologies like cryptocurrency, you know, AI in finance, fintech?
I have a short but framework to think about it, which is if you look at the innovation cycle, it's technology leads, capital markets follow, and then regulation lags. And that's kind of inevitable, right? I mean, that's just, there's not much that you can do to change that. And so it's always going to be 1 to 2 steps behind what's going on in the world. And so you have to sort of view it through that lens. And then also, you know, that it's not like archery where there's like a center target to hit, right? It's really, you're just trying to hit the target broadly. And so to the extent that you can generally hit the target and then narrow in afterwards, but the first and second and third attempt are often going to be either maybe too much or maybe too little. But overall, you're probably going to see, I mean, the expectation is going to see significantly less regulation. I think that's pretty widely accepted.
You're going to see less regulation in the next few years. There's a story or a theory in industrial organization that regulation really exists to protect entrenched interests. And it may be no surprise that, you know, the calls for regulating AI and things like that, the new technologies are coming from some of the biggest companies, which do have entrenched interests in the field. So we're going to get less regulation going forward because the people that our new incoming president has been appointed are very anti the types of regulation that existed in the past. But there will be regulations, and that's just the nature of government. And there's all kinds of interests that promote that regulation for both good and sometimes nefarious reasons.
And one of the problems is, I think it's called Martech's law, the private sector, you know, increases sophistication at kind of geometric rate and government is much more linear. And so even aside from regulation, you have California, the world's crucible of tech innovation to the world, and they're still using COBOL, a 50-year-old software programming at various departments. This is how we lost $32 billion through the Employment Development Department from COVID. And you just can't have that. Like, the world has enough issues that it's facing that you can't have those type of deadweight loss inefficiencies. So we need the Argentina treatment here.
Okay, let's talk about some individual asset classes. So the stock market, what do you see kind of in the short term? Do you think that it's poised for a correction or more volatility? What are your thoughts?
Well, I don't think you can predict the stock market. I mean, that's just my research and the research of so many others in the field. You can talk about distribution of outcomes, and, you know, on average, the stock market's going to go up, but that doesn't mean that 10 years from now, it won't be lower than it is today, or 20 years from now, that it won't be lower than it is today. It's less likely that it's going to be lower than it's going to be higher because there's a mean return attached to bearing that risk. There are times, you know, they have a colleague named John Cochran, who is now at the Hoover Institute, who pointed out that every time the price earnings ratio of the S&P 500 has gone above 20, 10 years later, the stock market is about where it was or possibly lower than it was 10 years earlier. You know, but these patterns are really not reliable for coming up with statistical inference. You need many more experiments of PEs being above 20 to have any kind of conclusion that would be scientifically based about where things are going to go. People said, you know, 9 times out of the last 10 times we had an inverted yield curve, we're going to get a recession. Well, there was no recession. So, you know, there's always exceptions that break the rule. Generally, I'm of the belief that with price earnings ratios so high right now that probably the expected return on the stock market is lower than it typically is. But that doesn't mean you shouldn't invest in the stock market. You still may get a 4 or a 5% premium instead of an 8 or a 10 or 12% premium to investing in treasury bills. And but I'm not going to wage into it's going to be lower next year or higher next year than it is today. There's going to be an outcome, and it's kind of like gambling. If you know the odds, the stock market, the odds are in your favor, you're going to win, but that doesn't mean you can't lose.
Yes, since this is the Anderson forecast, I'll take a broad perspective similar to what you did, which is, you know, also in the interest things that don't change or have been historically true. The stock market's been higher at the end of every single presidential term, with only one exception or 2 terms. So 18 of the 20 most recent terms, starting with Truman, have been positive, and it was just Bush 2 who had negative market returns, with the unfortunate timing of starting during the dot-com bust and then finishing during the global financial crisis. So that kind of explains that to some extent. And then the second is, if you take that 4-year period and you say, well, markets go up, equity markets go up 3 of those 4 years, and the average it goes up is 21%, and the average it goes down is 13%. And you play that out over a period of time, I mean, that gets you to roughly your estimated expected return of equities go up 10% a year. Now, we all know that they actually almost never go up that number. It's usually something meaningfully different from there. But I think that's a framework with which to think about without trying to actually call, like, you know, short-term timing or seasonality or you know, news headlines or things like that.
Ken?
I looked, I think the equity risk premium is slightly over 4% on Swap the Motor, and he has a great.
He was our student too.
Yes, I remember. Brad Cornell's, right?
He went, yeah.
Yeah. So I look at that, you go back to the bubble period internet, it was down to 2%. And so that's another indicator of, you know, potential returns over the risk-free rate. But one thing that's disconcerting to me is I'm seeing a lot more narrative-driven flows. And so MicroStrategy would be a good example, right? This is a stock that's in my benchmark, and it's basically a giant levered Bitcoin play. And people are drawn to that. So we have social media, we have, you know, you have meme stocks, and this is like a huge cap, you know, billions of dollars playing this arbitrage. And it's unsettling for me, again, somebody who's kind of steeped in the theory, but there's plenty of people driving new cars with MicroStrategy investments. So, and even, you know, AI things, people tend to get manic. NVIDIA, you can look, their financials are amazing. There's another company that was in my benchmark, Supermicro. Not a great company by my estimation, 15% gross margin, rack producer, went 20x just on the AI narrative. And then it came out, oh, there's some financial improprieties and other things, nothing to see here. And it completely round tripped. But this is the daily kind of mark to madness, if you will, that's narrative driven. And the other big trend we're seeing, or you're seeing writ large in the markets, is the shift to more private and companies staying private longer. OpenAI just did a round that valued them at 150 billion. Now, this was formerly a nonprofit that's now a for-profit that's not publicly traded, but 150 billion is, again, mega cap in the private markets. So when I started my career at Franklin, I would look at $300 million IPOs. Even 2005, Netflix was like $1.5 billion market cap in the public marketplace. Like there's nothing like that now. There's far fewer IPOs. Things are staying private longer. And when they do come public, like Reddit, it's already at a much higher cap range. So from my world perspective, if I'm a French small cap stocks, like the world's upside down.
Let's pause for questions from the audience. Anybody? Yes.
We talked about the concept of buying the dip, so I'd love to hear from each of you what your definition of a stock market dip is. Whether it's a percent per day, whether it's a percentage range over a course of 5 trading days. So I'd love to get your perspective on your individual definitions of what constitutes a dip.
My dip is the PE ratio in the market. And when it's sufficiently low, I can bear the risk and I'm not afraid for it to be high. But to sit and say, the market went down yesterday by 5%, it's going to go back today. Yeah, that's probably because a lot of stocks at the close yesterday closed at the bid price. And, today they're closing at their ask price, which for a typical small cap stock, can be, sufficient to generate a reasonable return. But I don't have a pattern of myself of actually going into the market. I mean, markets are not perfectly efficient, but I haven't seen a lot of evidence that, buying after the market declines 5% or 10%, that you actually make money. You can find historical periods where that's the case. And that will always be the case when you've looked at a 45-year bull market, as we've had right now. That's just statistics. But I can't say going forward that because the stock market goes down a lot, there's usually some reason behind that. It may turn out to be an ephemeral reason, but you don't know when you're going through that. And you see that all the time. I mean, we talk about changing technologies, and should I, you can sit and look at NVIDIA when it went to, before it had the stock split 600. You say, well, why buy NVIDIA? This is crazy. And then it doubles. Why? Because there's a new technology that people think is going to revolutionize the world, and that NVIDIA's in the driver's seat with virtually monopoly power on these graphic chips. I could see the excesses in hindsight back in 2000 and 2001. But at the time, we thought the internet was going to revolutionize the world and make the economy more efficient, just like AI is viewed today. Instead, the internet brought a lot of price transparency. Companies had to compete more aggressively on prices, and actually didn't bring the hope for profits to companies. So the stock market went down between 2000 and 2002.
For me, it's been much more event-driven, so less from an index perspective and more, I remember when 9/11 happened, and then also with COVID-19, you had anything travel-related just sold off precipitously. And so nuclear war, I'd be in the bunker. I don't think I'd be trading. But for things like that, you can look out 3 to 5 years and say, okay, there'll be a return to normalcy at some point. And that proved to be a fairly good bet.
Yes, go ahead.
Oh, definitely an opinion. I was just actually like mindful of time, but just sure. So if you take, say, volatile, take the VIX of the market and say that's your volatility range, right? And you say there's a 2/3 probability that if it's 15, then say there's a 2/3 probability that it'll be down 15 or up 15, right? On the assumption that it's symmetric, which it generally isn't. So say 15 is my boundary. So down 15%. But I don't know what's going to get there. So I'm going to say, hey, at 10%, I'm probably going to do about half, right? But to Mark's point, which is an excellent one about the ephemeral nature, and if it's going down for a reason, that reason isn't a one-day reason. Although you've seen a lot of that lately, and that really changes people's behavior. So behaviorally, people are responding differently to it, like in shorter timeframes. But if you said, yeah, 10% would be half, 15% would be another quarter, 20% would be another quarter, and those 2 times when it went through that, then you just kind of, you're in Ken's bunker at that point. Like, you're just not happy, so.
Go ahead.
Yeah, I had a question about regulation and quantitative tightening risks. It might be really valuable to hear you guys speak about that, since quantitative easing is what more or less I imagine got us through the 2008 financial crisis. And now they're trying to tighten again, spiked back up with Silicon Valley Bank. So, in terms of security and risks, and is it worth tightening down? What do you think that's going to do to the economy? And how do you think our administration will be handling that aspect of finance? So quantitative tightening, what's your take on it? It's new territory, so it might be really valuable to hear about what you think.
I wish I was a macroeconomist and had a really good answer to that. I don't know what it's going to do. I do know they went into a ton of quantitative easing. They're changing the maturity structure. They've made mistakes. You can also tighten or ease by simply deciding what securities you're going to issue, long-term versus short-term. Fed made a huge mistake in that it was issuing short-term securities because short-term interest rates were zero. What they should have done was lock in 3% long-term rates. We wouldn't have this kind of problem we have right now. So the flip side of the quantitative tightening and quantitative easing is the Fed is essentially trying to change the maturity structure of what's effectively the US debt. They could have done that through primary issuance to begin with, and now they're realizing maybe they made a mistake in doing that. But what it's going to have on the economy, whether, really depends, it just seems like a very complicated issue of, long-term financing versus short-term financing, and which one is in short supply versus which one is in, plentiful supply. And I don't know what's going to make the economy work the best. It could be quantitative tightening is not going to hurt the economy at all. I just don't know.
Just last question, just to end on a positive note. We've talked a lot about headwinds and risks and things to be worried about and bunkers and nuclear war. Just really briefly, what do you feel optimistic about, if anything, looking into the economy and markets ahead?
So I can say everyone should order Ezra Klein's new book coming out March 18th on abundance. So this is the Democrats who are trying to understand why they lost. This book, I think, will be a blueprint and a North Star for what Jerry, one of the things he highlighted. There's not housing growth here. People can't afford housing. They're not having kids. We need, and you're starting to hear this from the elected officials, at least Rivas in the Senate and the Assembly, about affordability. Like, California really is unaffordable to a vast majority of people who live here. And so abundance and that movement, it's called supply side progressivism. There are a lot of hurdles, but that's something that I'm personally very optimistic about.
I can give just a very brief financial answer and psychological answer, which is you're financially rewarded for being optimistic. So that should be maybe your default case. And psychologically, it just feels better.
I'm always an optimist, but I don't think it's by nature. It's the history of the human race. I mean, we do take 2 steps forward and 1 step back, but then we always take 2 steps forward again. And, freedom is probably as great as it's been around the world today. We've got all kinds of growth prospects due to new technologies that are coming on. And yes, I poo-pooed the elderly people like myself and the medical costs, but AI robots might take care of me. And then we don't have to worry too much about the motivations of young people. They'll be programming, for the AI and making the world a better place and getting rich off of it. So who cares if there's a big overhang of senior people in the world? I think you have to be impressed with, if you have a long view of history, with where the world has come from in a very, very short period of time. I mean, the Middle Ages was an exception where political order completely collapsed around the world. And as a consequence, you needed the protection of the knight or the king. You had to be within walls, because if you worked out in the fields and slept out there, you'd be killed at night. Or some foreign army would come and take you as a slave. That was the way the world was. And if you look at where the world is today, yes, there are parts of the world that are clearly not achieving what the developed countries have, but the aspirations of those people remain the same. The intelligence of the entire human race is greater than it's ever been, and it's only going to increase. And I think it's generally moved forward towards, goodness and prosperity. So history tells me to be optimistic.
Excellent. And we will listen to you, Professor Greenblatt. Thank you so much. Thank you, everybody.
Thank you, Lori, and this great panel. I learned a lot. On a side note, I also learned that my skills as a COBOL programmer are not obsolete. So I was happy about that. But in terms of financial markets, I learned a tremendous amount, as we all did. So many thanks to Lori, the Fink Institute for Finance, and our panel. This concludes our program. And our next program will be on March the 5th. And we're going to be focusing on technology during the first year of the coming Trump administration, with an emphasis on Silicon Beach, what's happening with technology here. And before you run out to enjoy the 405, I'd like to thank our sponsors again. Again, we can't put on these programs without our sponsors. They are very important, and we're much appreciative. And our principal sponsors, RSM and Yamava Resort and Casino at San Manuel. Our platinum sponsors, law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Mercury Insurance, and University Credit Union. At the gold level, Avenue Insights and Analytics, California Steel Industries, Hub International, Leap Development, PNC Bank, Robert Half, and United Airlines. At the silver level, Bank of California, Chevron, Comerica Wealth Management, JLL, Marsh McLennan Agency, MBK Real Estate Companies, U.S. Bank Private Wealth Management, and Wilmington Trust. At the bronze level, Hanmi Bank and HDR, and the Bruin level, Gerber Kawasaki Wealth and Investment Management. Many thanks to them. And I've said this before, but it bears repeating. If your organization wasn't just thanked for supporting the forecast, come see us. We can fix that. So enjoy the rest of your day. Thank you for joining us for the program. Look forward to seeing all of you on the 5th of March.